have today Laura Cha, who is connected to us electronically, live from Hong Kong. It's 9 p.m. in Hong Kong. I think, well, we've already talked about Laura. She's one of the most distinguished Executive Council of Hong Kong. She's a director at HSBC. She has served in the China Securities Regulatory Commission, and recently at the National People's Congress of China, which is a remarkable set of achievements for someone, for any one person. And I understand that the first Hong Kong citizen to serve in the government of the People's Republic. But I guess the really big thing that comes to my mind is that HSBC is one of the most important and biggest banks in the world. And I looked up and I find that there are 5 branch offices of HSBC within a few miles of right here.
Yes.
Anyway, Laura, I'm looking at you there.
Yes.
Why don't you could introduce, give us a talk about what you do and what your thoughts are about the financial situation are, and then we will turn it over to questions.
Okay. First of all, good morning to you all. Thank you, Bob, for inviting me here by electronically. It is my honor to have the opportunity to talk to you. When I was invited to give this talk, I went on the internet and see that your course syllabus is very comprehensive. And I would imagine that at the end of the course, you would have covered or will cover just about every aspect of the financial markets. And you will have a good idea of the function of the markets and how it works. What I want to do in the next 20 minutes or so is really to give you an overview of what it is like to work in the financial market, to have a job in the financial market, and perhaps eventually you may want to have a career in the financial services. And then, after that, I will be happy to answer any questions that Bob, you or any one of you want to raise with me. I think when one talks about a career or job in the financial services, one tends to think about the private sector, the banks, the investment banks, the fund management companies, and of course the traders, both in terms of stocks, futures, options. Of course, in the last decade, hedge funds, private equity. There's no question that the private sector is very exciting. There's no question that a job or career in financial services in the private sector is, by the most of any standard, is very, very financially rewarding. But what I really want to talk to you about is the other side of the financial market, which is the public sector side. And I want to share with you my own experience in the public sector. When we talk about financial services, as I mentioned, we talk about the banks, the intermediaries, what we call the intermediaries, the practitioners, people who practice in the financial market. If you are a college graduate, typically if you go to one of these firms, you start out as a research assistant. You do research. If you are in a bank, you will learn to read how to interpret balance sheets, how to decide what, when people come to you for loans, how you evaluate them and what are the credit worthiness of the potential client, whether you should or should not lend money. If you go to work for a private equity firm, you do the same kind of research, except that it's for companies. You will help the firm decide whether a particular transaction is worthy to take on. And in between, of course, there are all kinds of financial mechanisms or tools, products, as one would say, that you devise, that the market devise, and to facilitate these financial services. And those have been covered in your course, I can see that. But as I mentioned, the other side of the financial service, the other side of the financial market is really the regulators, the public sector side, the policymakers, the standard setters, bodies such as the Financial Accounting Standard Board. And all these are the other part of the equation which help to make the financial market function well. And it is important for the public sector to have equally bright students. I think some of us get a little worried. In the last decade, a lot of the bright students who want to go into financial services all go into the private sector. The public sector is important because the regulators and policy setters help ensure that the market function in an orderly fashion. We want to make clear as regulators and policy setters, we want to make sure that the market not only function properly, that the playing field is level, that the rules are clear, and so that financial service and finance can indeed perform its function in society. And that's where, when we have in the US, when we have the SEC, the CFTC, the Fed, and of course the exchanges, and not to mention the Department of Justice, the State Attorney General's office, et cetera, et cetera. What the public sector do is really to make sure that people on the private sector, in the banks and the investment bank, the fund managers, and so on, they behave properly, so that the investors are treated fairly and equally, so that everyone is entitled or are given the same kind of information, so that no one particular group is has an advantage over the other group. And that's where investor protection comes in, corporate governance comes in. And I myself, my career has largely been in the public sector side. Although I started out as a lawyer, I was trained as a lawyer, and I practiced as a lawyer for 7-8 years in foreign direct investment into China in the 80s. And I dealt with a lot of multinationals and in the corporate side, in the finance side. My foray into the public sector as a regulator was really, it came out of the blue. I was headhunted to join the newly found Securities and Futures Commission in Hong Kong. That was 1990. And I thought I will do it for a couple of years, learn to broaden my horizon and see what it is like to be in the public sector. And I enjoyed what I did, and then I stayed 10 years. And then I was made an offer by the central government, and I went to work for the Chinese regulator for almost 4 years, and became the first person outside of mainland China to join the Chinese government. So I had a total 14 years of experience as a regulator. And I have to say that it has been hugely gratifying, because as a regulator and a policy setter, I was able to facilitate the development of markets in Hong Kong. In the early days, Hong Kong was in the early days, I mean in the 70s and the 80s, Hong Kong was a largely local market. The international players like Goldman Sachs and Morgan Stanley, they came and went, they took a look and decided the Hong Kong market was too small for them. All that took a change in 1992, when the Chinese government decided that they want to use the Hong Kong market as a way to help transform or reform the state-owned enterprises. And by that time, I was already at the Securities and Futures Commission in Hong Kong, and because of my experience working in the Chinese market in the 80s, I became the only person who was familiar enough with the Chinese market to take on that responsibility of really designing a structure for state-owned enterprises in China to become listed companies in Hong Kong. And it was groundbreaking work. At the time, we knew that it was very important. We didn't know how important it would become later on. Some 20 years later, Hong Kong market now is a totally international market. All the big players are here, and all the more than half of our market capitalization came from Chinese enterprises. More than half of the turnover on our stock exchange are from Chinese-related companies, a Chinese company directly, or what we call red chips. So the coming of the Chinese enterprises to Hong Kong really transformed not only the state-owned enterprises in China, but also the nature and stature of the Hong Kong market. I think today, most people will recognize that Hong Kong is an important financial center. And I would say that without the Chinese enterprises, we would still have been a very local market, because our economy itself, Hong Kong's economy, has not been that big. It really is what had happened in China that had propelled our change. And as a regulator, I was fortunate to have that opportunity and to help structure the market and spearhead changes. The other thing that I did as a regulator in Hong Kong was in the late 90s, 98, 99, and 2000, there was a wave of demutualization of stock exchanges throughout the world. And I helped demutualize the stock and futures exchange in Hong Kong, merged them together with our clearinghouse, and the stock exchange of Hong Kong became a listed company. Today, it is the largest, it is an exchange, it has the largest market cap in the world, more than New York Stock Exchange and London Stock Exchange. And when I went to China, the market was in a nascent state. Bearing in mind that it was a communist socialist country, capitalism was a new thing, and stock market was an even newer thing in 1991. So I kind of witnessed, and then later on was fortunate enough when I went to work in the Chinese government to participate in the growth of the Chinese market. And what I did in my almost 4 years as a Chinese regulator was to promote corporate governance. I introduced quarterly reporting, the requirement of independent non-executive directors, and it was exciting times. What I want to say really is the public sector work that would, at least for me, I felt that I was making a difference. I was able to help the market change. And if things were not right, I felt that I had the ability to make things right, to make things correct. Not always successful, I have to say. But what I want to really impress upon you is that while the private sector work in the financial services is extremely financially rewarding, in the public sector it's less so, but on a different level, I think the policymakers do perform a social good. And the good thing about the United States is is a lot of interchange between the public and private sectors. People do move from the private sector to the public sector and back again. I think that's what makes the US market vibrant, among other things. And I think it is a tradition that many other countries and jurisdictions want to emulate, namely the people who have been in the private sector, who has the experience, who have market experience, are needed in the public sector. In other words, you cannot have regulators who have very little knowledge of how the market works. At the same time, those people who have been in the public sector have kind of instilled on them the discipline of an orderly market, doing the right thing for the market. And that, when you have it transplanted or being brought back into the private sector, it is also a good thing and healthy for the market as well. The other thing that I want to really talk about, other than the public sector work and as a career choice or as a job choice in the financial services, is really the globalized nature of the markets these days. I think in my days when I was going to college and law school in the United States, the US was, and I don't mean by saying that it is no longer, but it is still, everybody looked to the US to be the center of the world, particularly in financial services. Everything happens in the US, and to a large extent it still does. But I think the world outside the US has undergone a lot of changes. A globalized market means that today, young people will find equally interesting and exciting work opportunity in financial services outside of the United States. I think in my days, in the 80s, certainly people, when they say they want to work outside the US, it would be in a mature market like Europe, the UK, or Japan. I think increasingly more so in the last decade, opportunities in Asia and in Latin America in financial services have become very exciting for young graduates anywhere. And I would say if you are equipped as a young graduate and you want a career in financial services, I think you should not rule out the possibility of working in a foreign country, in the emerging market in particular. I think in an emerging market, you will learn in a way faster because you will be given more opportunities, more responsibility at an early age, and your learning curve will be steeper. And it is also interesting as well as frustrating, I have to say, working in a developing market. There are things that you think that you can do, and then there are things that the rules are not as clear, and the environment and the people around you are not as sophisticated or educated as you are. But I think in today's world, the globalized market means that the opportunities are everywhere. And I think particularly the emerging markets will offer a lot of opportunities. Bob, I don't know whether this is enough as an introduction for us to carry on discussion, or how do you think about that?
Yes, very good. I'll turn and face the class. I can't see you very well, but I thought it was very interesting hearing your comments. What particularly struck me was your emphasis on the public sector and about regulators. And it reminds me, I visited the SEC once recently in the US. I had lunch with people there in Washington. And I found that a lot of them had worked in the private sector in the past. And I was starting to wonder, they must have taken a big pay cut. Why are you here at the SEC? And then it crossed my mind, well, maybe they're losers. Maybe they didn't make it in Wall Street. They can't. But when I talked with them, I got a different idea that maybe they're here because they find all aspects of finance exciting. And maybe the purpose of life isn't to make a huge amount of money. So I wonder if you agree with my assessment. I mean, why do people work in the public sector anyway if pay is lower? And that's a very open and big question. Maybe you have a response to that.
I think there are a couple of reasons for that. I think one, that a career in public sector need not be permanent. You can work in a public sector for a number of years and then go out into the private sector. And your public sector experience is hugely marketable, if we could use that term. I know that particularly in the US, if you had experience with the CFTC and the SEC or the Fed, you are provided that you're not really just in the technical aspect and you are in a broad policy aspect, I think you have a very marketable skill that people in the private sector don't necessarily have. If you change job in the private sector, one bank and one private equity and another hedge fund, they will be more or less the same. But I think in the public sector, that's where the difference is. That's one. The practical aspect is, of course, it is more steady work. In the financial, how should I say? Yes, the financial reward is huge in the private sector, but also, it is subject to a cyclical. When the market is down, there are massive layoffs, and in the public sector is a little more steady. So it's a different. I think it could be a different phase in one's career. At a certain phase, you might want to have a more steady, or you want to accumulate enough experience before you go out into the private sector, or vice versa. And I have seen, among our friends, among the regulators, some people felt that they have made enough money. Enough is a relative term. They make enough in the private sector. They want to go in the public sector for a few years. I think that's also one of the reasons.
Yeah, listening to what you said, it seems to me, in some sense, working in the public sector is an opportunity, but also maybe a mission. When I'm thinking of what you help achieve for China, I think it's a really important mission in that you are getting the financial markets working right. And the things you talked about, like independent directors on Chinese companies, is a way of combating the problem of corruption. You didn't use the word corruption, or maybe that's too strong a word, but where things aren't up and up. And I thought that part of the motivation that maybe, I'm sure you have, maybe you can confirm this, is just a sense of being part of history and part of making things right.
Yes, I think absolutely. When I joined when I became a regulator, I thought it was just going to be 2-3 years. I was going to broaden my horizon, and it would help my career in the law. And then just one thing led to the other, and I find that it was extremely, how should I say, it was very gratifying for me to be in a position where I feel that I was really participating in the development of a market. I'm sure colleagues at the SEC and CFTC feel the same way in a different manner, because obviously the US market is at a different stage. And even among the regulators, there are the people who are in enforcement, where they try to catch the bad guys, or the insider dealing cases that we see nowadays. Those are the enforcement, and of course the Department of Justice, the State Attorney General's office. Those people also, I feel, that feel that there is a mission. I think that's also a very important aspect of financial market. I just don't want young people nowadays to think of financial services purely in the private sector.
Another of our outside speakers in this course this semester was Hank Greenberg, who, he actually succeeded C.V. Starr as the founder of what was then the world's biggest insurance company, AIG. And one of the things that he told us was that how did AIG get so successful? Part of it was because it embraced the emerging world. And even when it wasn't popular to do so, AIG was founded in, I think it was Beijing or Shanghai maybe, a long time ago. And I thought that maybe he and you have a similar, it seems like the emerging world is obviously more and more part of our economy and will continue to be. And that business being connected through we're getting more and more international, as you were saying. It kind of makes for a different life. And one thing that AIG and Hank Greenberg emphasized to us is that he has a life of diplomacy in some sense. He became a diplomat, or like an ambassador from the business community. Because to work with all these different countries requires a certain sense of mission and purpose and skills. I don't know if this is a well-framed question, but it seems like what you were saying implies an interesting career involving in the emerging world, and a career that involves a broad scope of skills, not just narrow finance skills. Does that prompt you?
Yes, yes. I very much agree with Hank Greenberg's view. I think when you work in an emerging market or you work in emerging markets, you develop a different set of skills. And I think in today's globalized world, there are more and more multicultural global professionals. I think, we're talking about 20, 30 years ago, US expatriates, for that matter, any other, expatriates from the UK, for example, go out to the emerging market, and people kind of use it as a stint. You work for, 5-6 years, and you go back to your homeland, and your roots will be in your homeland, which is, perfectly fine, and that's what most people do. But I think in the last decade, I have seen and I have come across more and more young professionals who, because of the education, because of the background, what I would call global professionals. They're multicultural. Many of them are multilingual, and they will move job to job in the overseas market. And people look upon it as life's adventure. You live in a country for 5-6 years, and then you move on. And the skills that you acquire along the way really enrich yourself, enrich oneself, and eventually, if you do go back or not go back to your homeland, it is some skill that will stay with you and it change your perspective. And I think that kind of skill are becoming increasingly important when we have more and more cross-border transactions and globalized market where something happens in one market has an effect, way beyond the borders. And that's what we're seeing more and more nowadays.
I was going to ask the class for questions. While you're thinking for a moment, let me ask one more question of you.
Sure.
I just wondered about HSBC, which is another bank that like AIG, it originated in Hong Kong and Shanghai, but it has become such a world force. And I kind of wonder, when did that happen? How did that happen? Can you give us a nutshell?
Sure.
Because it doesn't happen to every Asian bank.
HSBC started in Hong Kong 1865. Within a few months, the Shanghai office, the Shanghai branch was set up the same year. So we've been here, 160 years or so. Originally, it was trading, dealing with trade finance and so on, and it became the largest bank in Hong Kong over many decades. And the international push really started in the early 90s when the HSBC started acquiring different banks. It acquired the Marine Midland Bank in the US, and it acquired the Midland Bank in the UK. And from a financial institution which was largely local in Hong Kong with businesses in Asia, it started its international. It became an international organization by acquisition. So the head office moved from Hong Kong to London, I think around 92, 93, when the HSBC acquired the Midland Bank in the UK, and the Bank of England require the HSBC to have the domicile in London to be regulated by the Bank of England. Since the 90s, the HSBC has acquired one of the largest banks in France called CCF. It's now called HSBC France. It has acquired Bank of Bermuda in Bermuda, and it has made a lot of acquisition. Of course, the most famous or infamous acquisition in the US was Household Finance about less than 10 years ago. So HSBC became an international financial institution really in the last, I would say, 15 to 20 years. Now, today, our profit, 1/3 of our profit comes from Hong Kong, 1/3 comes from the rest of Asia, 25% or so from UK and Europe. The US, it's about 6%, and Latin America about 9%, roughly. So Asia is a hugely important market for HSBC. And the acronym is Hong Kong and Shanghai Banking Corporation, which was the original name when we were set up in 1865. So it is, we do not have a controlling shareholder. We are truly diversified in our shareholder base. Our largest shareholder holds no more than 3 to 4%. It's an institution investor, so they represent many smaller investors. So it is really run by the management, professional management, and it has done I would have to say, a very good job in the last 2 decades.
Okay, any? Allie.
Hi, thank you for coming. I was just curious, a lot of people have mentioned that the lack of regulation and enforcement of contracts is a main barrier to foreign investment in Asian bond markets. How do you think China will address this? And what are the primary differences in the regulation between China and the United States?
Can you say your question again? I didn't catch it. I only hear the regulation. Can you say that? Can you tell me your question again?
Yes, many people have mentioned that the lack of regulation and enforcement of contracts is a main barrier to foreign investment in Asian bond markets. How do you think China will address this?
How do I think what?
How will China address this issue?
Oh,
okay. The lack of regulation.
Right. I think China does not have a lack of regulation. There are lots of regulation in China. What I would say is that there has to be better application and enforcement of regulations rather than periodic and not consistent regulation. I think one of the most important things for the market in terms of regulation is that they have to be clear, they have to be consistently applied, and they have to be fair. It is not a lack of regulation that is a major problem. I think as in many emerging markets, China is still trying to grow with the issue of stringent enforcement. And I think the regulators in China recognize that there is a lot that they need to, they have to do better in terms of enforcement. And the problem that I see in China is that it is developing so fast. The market is way ahead, developing faster and quicker and bigger than the government and the regulator have anticipated. If we put ourselves back in the US, and let's say in the crash of the late 20s and when the SEC was set up in 1934, I would say China is probably slightly better than the US in those days. But if we compare with the development of the US market in the last 5 decades or so, of course the US has developed a lot more. And China does not have the luxury to wait 50 years for its rules and enforcement culture to develop. And it is catching up. Whether the lack of regulation is therefore an impediment to foreign investment, I think you'll have to look at it from several angles. China to date is the largest recipient of foreign direct investment. So, in a way, if the conditions in China is so bad, it would not have attracted so much foreign direct investment. I'm not saying that the environment in China is really, top-notch to compare with the developed market, but there probably are enough opportunities and people do make enough money so that it is, by statistics, the largest recipient of foreign direct investment. And that is, a fact compiled by, international agencies. So I don't think that it has been an impediment. It is an impediment when we talk about individual cases. It is far from satisfactory.
Could I just interject a question there? Some people say that the SEC in the United States could use much more resources. Does China give enough resources to enforcement? It seems to me that there is a problem in emerging countries everywhere that it's expensive. And the country has a budget, right, which is still attracted to other things. So do you think that China devotes enough resources to enforcement?
I think every regulator would tell you that they need more resources as far as enforcement is concerned. I think China could certainly do with more. I think one aspect is that you have to have enough people to carry out the enforcement. And it is trying to catch up. And as I said, because the market is developing so fast that the regulators are always trying to play catch up. And that is not ideal. I think the SEC could do with more resources. I would absolutely agree with that. And any regulators you go to, they always felt that the under-resourced aspect is the enforcement.
Other questions? Right here.
I was wondering if you think that there are any impediments to development in the Chinese or Hong Kong markets based on the government of China. You mentioned earlier that there was a communist tradition, that a lot of the businesses that you worked with were state-oriented or state-owned. So I was wondering if you think that that will have to change in the future, or if the market will change or in some way adapt to allow those to continue to operate as they do now.
Do you mean the state-owned enterprises?
Yes.
When you say impediment, what do you mean by that?
You mentioned that there was a tradition of communism and state-owned enterprises, that a lot of the businesses were a little bit wary of a capitalist system, and that you played a pivotal role in introducing that idea and really implementing it. Do you think that that type of change will continue?
Very much so. I think capitalism has taken deep root in China already. If you go to China nowadays, the state-owned enterprises very much operate as any other enterprises. The difference is that the controlling shareholder, it's the state, is the some sort of government entity. But it operates, if you look at some of the larger state-owned enterprises like China Mobile, PetroChina, some of these large China Telecom, they are state-owned enterprises, no question, because their majority shareholder, the controlling shareholder, is the state. But it operates in a commercial way. Of course, some people will say that there are policy, preferences, advantages to be a state-owned enterprises. But I think by and large, now the state-owned enterprises, particularly those that are listed on the exchange, and some of those are listed in the US market as well, they do have to operate in a completely commercial manner. They have shareholders to answer to other than the state. They have minority shareholders who are public shareholders. And I think that's where the discipline comes in, the market discipline comes in. So when you say whether there should be any change, whether any change will take place, change have already taken place and will continue to take place.
Is there another? Let me just add something. It occurs to me that, at least in the US, there has been a policy going back to the 1930s of trying to encourage little startup companies. We created the Small Business Administration, which subsidizes. The idea has been that big things grow out of small beginnings. I wonder if you could comment on China. Does China support young startups adequately?
Yeah. It does. It has been now 2 years since a Growth Enterprise Board had been set up in the Shenzhen Stock Exchange, what we call the GEM board. And it has a lower listing criteria, and that is more or less a buyer's beware market. I mean, it is like any other buyer's aware market. It's fraught with a number of high-profile, high PE companies, which may or may not develop into something more concrete. But I think the idea is to use the capital market to nurture the small business. That's the growth enterprise market. Some stock exchange, which is across the border from Hong Kong, also have a part of its board. It's called Small Medium Enterprise Board. So if you are not a growth company, but you are a small and medium-sized company, then you are listed on this other board. So there are two specific boards addressing exactly what the question you raised, namely to nurture the smaller companies.
Hi, could you give a couple examples maybe of like the skills you learned in the public sector that helped you now working at HSBC, or maybe like a situation where because of what you learned in the public sector you had better decision making?
That's a good question. I think what I took away most from my years as a regulator is really to look at an issue from a macro level. I think in the private sector, when you are given a problem, when you are, let's say, in a private firm, in a bank, or a law firm, or any professional firm, you're given a set of problems. Perhaps a client has a certain problem, and your role is to help solve that problem. And the context of that client alone, and that problem in the confine of that problem. And most of the time, you help the client to you will help the client to overcome some either legal issues or other commercial issues so that the client can get to where he wants to go, whether it's acquisition or merger or disposal, etc. In the private sector, in the public sector, as a regulator, you learn to look at the issue that is presented to you from a more macro level, in the sense that how does this particular issue impact on the market as a whole. I'll give you an example. A group of companies in Hong Kong came to the regulator in Hong Kong and asked for certain exemptions. The reason that they put forward are quite cogent and not unreasonable from the client's point of view, from the company's point of view. Now, if I were in my role as a lawyer, I would fight very hard for the client to get that exemption. But as a regulator, then I have to look, if I give the exemption, what kind of knock-on effect will have? What kind of precedent? It will set a precedent. And is it a good precedent or is it not a good precedent? If it is a good precedent, then it should not be just given to this one particular company. Then there should be, perhaps the rule should be amended in such a way that what this particular group of company wants should be given to everyone who wants to apply for it. But if it is not, and if it is just purely for the benefit of this one particular group of company, then you really should not give in to that exemption. And you do have to recognize that there are different considerations, such as the size of the group, the impact that it may have on the market, etc. So the skill that one learns as a regulator is really to look at the problem presented to you from a more from an over, you can at a higher level, you look at the entire scenario and how this piece will fit into a bigger picture, where in the private sector you don't need to. And how it's helpful to me now in my current position is that I am able, I think, to interpret policy and to anticipate policy, because I could see that certain things are happening a certain way, that as a regulator, those are the issues that the regulators are likely to address, and therefore, from the private sector, we should be prepared for the changes that will take place. So that's in a very abstract way. I can't quote you exact examples for obvious reasons, but that is in a nutshell. I certainly find that help me as a person to look at matters from a more from a broader point of view.
Hi, thank you. You spoke about the demutualization of stock exchanges, and one of the outcomes we've seen of that is the mergers and acquisitions of stock exchanges themselves. And I think in the last 1 year itself, we've seen a whole bunch of very interesting deals: Singapore, Australia, New York, Deutsche, etc. And one of the ones that really caught my attention was the Shanghai Brazil link-up. So perhaps I want to hear your views on: do you think this wave of tie-ups is going to carry on? And if so, what form do you think it will take in the coming years?
I think in the last decade, the exchanges around the world has really taken on, or more than a decade now, the landscape have completely changed. It used to be an exchange is kind of like a national symbol. Each nation has its own exchange, and that is almost like a national, how should I say, it's a utility that cannot be taken over by a foreign country. We saw that went by the wayside when the New York Stock Exchange acquired the Euronext and of course NASDAQ alliances and just different ways. And now we are into a second phase where these already consolidated and aligned exchanges are forming even more consolidation. Now, that may or may not happen. There's a lot of talk about it. And I think what drives this latest wave of exchange, how should I say, the acquisitions and alliances are really the ECN, the electronic network, that are driving the cost of trading down, that leave the larger exchange like the NYSE, a lot of the volume has gone to the ECN, and they really have to align with others to get the business up. The other is products. I think the merger of exchanges would only make sense when the two they are mutually complementary products. And geography also makes sense. And how would I see the outcome? I think many markets still look upon their, how should I say, the exchange as a national symbol, and they do not necessarily want. It's more as a matter of the local politicians' sentiment rather than looking at the commercial side and look at the political side. Someone once told me, this Singapore and Australian stock exchange, the pending merger that has been announced. I don't have the latest. I don't know whether it's going to go through. Somebody in Australia told me, well, it is almost like Qantas being taken over by Singapore Airlines. In the commercial world, well, if that makes sense, why not? But I think there is still a lot of sentiment towards stock exchange that is something very national. So I don't know how that will play out, because all these mergers are subject to the vote of the local politicians. And so they may have different consideration than just purely the commercial side.
Hello. Hi. Thank you for your time. I have sort of a two-part questions. The first part is, in regards to all these Chinese companies that are registered overseas, that's sort of a complicated regulation. So I was wondering if you could talk about how a lot of Chinese companies being registered overseas and being listed in overseas exchanges. And second part of the question is, I've heard, at least I've read, that there's a new international board that's being set up in China to encourage these companies to come back to mainland China or Hong Kong. So I was wondering if you could talk a little bit about how it's going to be shaped, some of its challenges, and what do you think would be most important for success?
Right. Okay. The first part of your question, Chinese company that are registered overseas and listed overseas. There is no rule that forbids Chinese company to be registered anywhere. I think, let's say a company in China, they can elect to register themselves in Hong Kong, in Bermuda, Cayman Island, wherever, US, Delaware. And the matter of listing is really up to the issuer itself. If they decided that a listing in the US, whether it's NASDAQ or NYSE makes sense, that's where they will list. And once they are listed, they are subject to the rules and regulations of the SEC, just like anybody else, just like any of the other foreign companies. So I think the place of listing really determine the kind of rules that will be applied to that company. Once a company is listed, let's say on the New York Stock Exchange, then the US rules will come in, and whether it is a Chinese company, then it's kind of irrelevant. It will have to be complying with the US rules just like everybody else. So that's the first part of your question. I don't know whether that answered it. The second part of your question about international board in Shanghai. Yes, there has been a lot of talk about the Shanghai Stock Exchange setting up an international board, meaning that a board where companies registered outside of China, such as the red chips, which are not listed in China, will return to the Shanghai Stock Exchange. Because they are not registered in China, they are therefore not a Chinese company. They are therefore kind of like a foreign company because they registered in Hong Kong or Bermuda or wherever. The idea of the international board is to attract not only these types of Chinese companies that have been registered outside, but companies that are multinationals that are already listed in the outside market to be inside China. And the major reason that I can discern is, one, to give the Chinese investor a wider variety of products. Because the renminbi is still a non-convertible currency, the vast majority of Chinese investors can only invest in the domestic market only in the Chinese companies that are listed there. They cannot easily invest in, let's say, Microsoft, HSBC, IBM, General Motors, etc. So, I think the Chinese government has thought, well, maybe we can bring some of the companies to China for these companies to raise capital and issue shares in China so that the Chinese investors will be able to access it. The second part is really to raise the profile and the standard of the Shanghai Stock Exchange. The Shanghai Stock Exchange has ambition to be an international financial center. And a domestic document have said that it should be developed into an international financial center by the year 2020. And one of the routes of reaching that goal is to have an international board for international companies. And that is what I think the Shanghai government and the Shanghai Stock Exchange are setting out to do. But to date, the rules have not yet been promulgated. We don't know when it will. I was a delegate to the National People's Congress, and we met in March, earlier this month, and there's no discussion or timetable that has been set. Many people think it will be a good thing. Some people inside China think that it will not be such a good thing because it will divert the savings to foreign companies. But I think most people think that it will be a good thing for China. So I don't know whether that answers your question. Do you have a second part to the second question? I might have missed it.
No, I think that really answered my question. But the first part, actually, the reason why I asked the first part of the question was because a lot of the recent sort of the frauds that came up happened or were discovered because a lot of Chinese companies were registered in the New York Stock Exchange had a filing with the SEC, whereas they also have a filing for their own government, the Chinese government, and then these filings for their annual reports or their numbers would not match. And I just thought there would be some kind of complications in terms of regulation when the government is regulating these companies.
I think I think that whenever a company is listed on a foreign market, it is subject to the full rules and regulation of that market. There's no ifs and buts. I think the U.S. authority would take action against any fraudulent or misstatement.
Okay, right here.
What type of law did you study, and how difficult did you find the transition from the legal world to the business world?
I studied most of the, I think in law school I took a lot of courses in corporate law, tax, corporate finance. I think the business world always interests me. The transition from law to, I think I did it was a two-step thing. I was a lawyer, and then I was a regulator, and then I was completely in the private sector now. So the transition from a lawyer to a regulator wasn't that difficult. I remember distinctly that when I moved over to the Securities and Futures Commission, what I wasn't used to is I always want to correct every document that came before me. I want to improve it. I mean, it was just the lawyer in me. I want to make it, could be written better, clearer, etc. Then I have to kind of restrain myself to really, I wasn't there to correct and make the to make a presentable document, but to really solve the problems. And then having been a regulator and mostly really regulating the corporate world, I became quite familiar with the corporate finance side. And when I was at the Securities and Futures Commission in Hong Kong, I was the head of the corporate finance division for 5 years. And during the 5 years, I came across all kinds of corporate transactions, merger, acquisition, takeovers, and of course the IPOs. So that kind of helped me in where I am today. I wouldn't really call me a banker per se, because I'm not in the operation side. I'm on the board, and then I provide advisory service to HSBC, but I'm not really operating as a banker per se. So I would say it wasn't difficult. It was an evolution type of throughout my career from one thing to the next.
Pass the microphone.
Hi, I was wondering, having worked on the regulation side and now working for the private sector, I think that's puts you in a unique position to determine what the impact of internationalization of regulation will have on the financial services sector. So, more specifically, what do you think the regulatory impact of Basel III will be? Because a lot of private sector individuals have come out and said that some of the requirements in terms of the capital adequacy requirements and so on have been very harsh.
Right.
So, first of all, I guess, how do you think it will be phased in? And second of all, do you think that it's the appropriate level of regulation?
Basel III, I think it is very costly to implement. I think the banks have largely accepted that more stringent regulation would have to come our way because of the financial crisis of the last 2 years. But not all banks are alike, and certainly at HSBC we felt that we have been thrown in with the rest of them. And whereas we had not taken any government money and we have done reasonably well, we have weathered the crisis reasonably well. But having said that, I think one has to accept that whenever there's a crisis, regulation will come in more stringently, and the pendulum will tend to swing too far one way, and then gradually the pendulum will come in the bull market. The pendulum will swing back, and then it will be too lax, and then another crisis will happen, and then more rules will come in. It has always been like that. If you look at the history of any market, they always swung to the extreme. Sarbanes-Oxley, I think, is a good example. Sarbanes-Oxley came about, I don't need to tell you, as a result of the Enron crisis. And of course, the last crisis, which was the subprime crisis, was nothing like Enron. So, the regulators, when I was a regulator, we always say we're always correcting yesterday's problems. When a scandal happened, when a crisis happened, we think of rules to address what had gone wrong. But the next time when something happened, it's not going to happen the same way. You are preventing just the old problem from repeating itself, but the new problem will be entirely different. So that's just, the way things are. And that's the other reason why I think some of the young and bright students should not always be in the private sector. The public sector needs a balance of that. And then as far as international regulations are concerned, the regulators have talked for a long time about harmonization of standards. I don't think it will happen because different regulators, different national regulators have their own priorities, and they don't always have the same priorities. And the best example is really the Financial Stability Board, which came out of the Asian financial crisis. It was called Financial Stability Forum. It is now a Financial Stability Board. And the idea is to ensure that there's financial stability globally. But that takes a lot of work. I think the G20 is trying very hard. And of course, the regulatory agencies, as well as all the central bankers, are now hopefully in a better cooperative mood. But I think to have one set of international and harmonized standards is very hard.
Okay, I think we're out of time. Laura, I just wanted to thank you. I think this was very good. Hearing the details of your career and hearing all the different things you've done in both the public and private sector reminds me of we're going through a period of development of the world and expansion, and somebody has to get the details right. And I'm very impressed that you are one of those people who's making things work. So I'm glad that you were able to convey these thoughts to our students here today, and thank you very much. Today's lecture is options. And I think maybe I better first define what an option is before I move to just saying anything about them, because some of you may not have encountered them, because they're not part of everyday life for most people. Although they are in a sense. I'll get back to that. Let me just define terms here. So I should turn the light on here. I don't know where the switch is. Well, I will just make do. So there's two kinds of options. there's a call and a put. Okay, a call option is an option to buy, and the price is called the exercise price or strike price. Those are synonyms. And a put option is the right to sell something at the specified exercise price. And it has another term that has to be specified, and that's the exercise date. Okay, options go back thousands of years. It must have happened before we have any recorded records. If you want to buy something, you're thinking of buying something from someone, but you don't want to put up the money today, you go to some lawyer and say, write up a contract. I want to buy an option to buy this thing. So, for example, if you are thinking of building a building on land that is owned now by a farmer, but you're not ready to do it, you may be thinking about it, you can go to the farmer and say, I'd like to buy that corner of that acre there. I'd like to have the right to buy it. I'll pay you now for the right. And you get a lawyer and you write up a contract. And that's an option. You have an option to buy at the exercise price until the exercise date. Now, in modern terminology, we have two kinds, American and European. And it doesn't refer to geography, those two terms. The terms refer instead to when you can exercise. So the American option is better than the European option for the buyer because the American option can be exercised at any time until the exercise date, whereas a European option can be exercised only on the exercise date. But you see, the American option has to be better, or not worse than, I don't know if it's strictly better, but not worse than a European option because you have more options. I think we've defined what they are. Do you understand well enough what they are? They occur naturally in life. I remember Avinash Dixit was writing about options, and he said, well, when you're dating someone and you know the person will marry you, you have an option which you can exercise at any time by agreeing to marry. Now, one of the theorems in option theory is you usually don't want to exercise a call option early. And so Dixit was saying, well, maybe that's why a lot of people have trouble getting married. They don't want to exercise their option early. What we'll see is that options have option value. They give you a choice. And so there's something that when you exercise an option, that means when you actually buy the thing, or in the case of a put, sell the thing, then you're losing the choice. So you've given up something. Of course, you have to also exercise eventually if things are going to make sense. Usually when we talk about options, we're talking now about options to buy a share of stock or 100 shares of stock. And that's the usual example. But they occur all over the place. Let me mention some other examples of options. The usual story is the stock option. You go to your broker and you say, I'd like to buy an option to buy 100 shares of Microsoft. I don't want to buy Microsoft, I want to buy an option to buy Microsoft, which happens to be cheaper, by the way, usually, costs more money to actually buy the thing than to buy the right to buy the thing at another price. We'll get back to that. But in a sense, let's think about this. Stocks themselves are options, in a sense, because with a zero exercise price. Maybe I'll have to get back and explain that. But what I mean is, let me get back and explain that in a minute. But let me go ahead to other examples. Mortgages, an ordinary home mortgage, has an option characteristic to it, in the sense that if the price of your home drops a lot, you can just walk away from the mortgage and say, I'm out of here. It's like not exercising an option. It's analogous. Or I can choose to prepay a mortgage early, and that's like exercising an option. So option pricing gets into all sorts of things. Okay, so I thought I should say something about the purposes of options before I move on to try to discuss what their properties and pricing are, which is the main subject of this lecture. I can give two different justifications for options. Why do we have options? Some people cynically think that options are just gambling vehicles. There's another way to gamble. You can go to the casino, you can play poker, or you can buy options. Well, I think for some people that's just what it is. They're volatile, risky investments that can make you a lot of money. But I think they have a basic purpose. And so, or purposes. First of all, theoretical. If we were trying to design the ideal financial system, what would we do? And I think back, some people thought of ideal economic systems without reference to finance. Like Karl Marx, I come back to him, the great communist, thought that we would have an ideal communist state and there'd be no financial markets. When they actually tried it and they tried to do it, I think they gradually realized that not having any financial markets makes our entrepreneurship, our management of enterprises kind of blind. We can't see where we're going because there's no prices. We don't know what anything is worth. There was an old joke that the communist countries survived only because they had prices from capitalist countries to rely on. Otherwise, they don't know anything about values or profits, right? So we need prices. And I just traced many people have written about this. But I mentioned in 1964, Kenneth Arrow, who is an economic theorist, wrote a classic paper in which he argued that unless we have prices for all states of nature, there is a sense in which the economic system is inefficient. You really need the price of everything, including the price of some possibility. And in a sense, that's what options are giving you, or the existence of options are giving you. So Stephen Ross, who used to teach here at Yale, a friend of mine, lives here in New Haven, in 1976 in the Quarterly Journal of Economics, wrote a classic paper about options, showing that in a sense they complete the state space. They create prices for everything that affects decision making. So I'm not going to get into the technicalities of the paper, but I wanted to start with a theoretical justification for options so that you'll see why we're doing this. I don't want this to come across as a lecture how you can gamble in the options market. This is about making things work right for the economic system, improving human welfare. But it seems a lot of people don't get that. That's why Karl Marx was so successful. It seems too abstract. What does this options market do for us? It just, but let me just go back to the example I started out with. You're a construction firm and you're thinking of building something, a new supermarket, right, where people can buy their food. And you note that there's a pair of expressways crossing somewhere, and you think that's the perfect place to build a mega supermarket because everyone can get there by car, and there's a lot of land. I can build a big parking lot. Perfect. But before you think further, you go to buy an option on the land, right? So you knock on the door at the farmhouse, and there's a farmer with all these acres, and you say, I'm thinking of building a mega supermarket here. I'd like to buy an option on your farm. You learn something at that moment. You might learn that the farmer says, I've already sold an option, so I can't do it. You could try to talk to the person I sold it to and see if you can buy it from him. But or the farmer might say, I've had 3 other offers, and I'm raising my price to some millions of dollars. And then you have a second thoughts about doing it. You see what I'm saying? That the price discovery is in there. It's making things happen differently. You're learning something. The farmer is learning something. You are learning something from the options market. And ultimately, it decides where that supermarket will go. So that's the theoretical purpose of options. But I wanted to talk also about a behavioral purpose of options, or it's a little fuzzier about the actual benefits of options from this standpoint. The behavioral theory of options says that it's very many different aspects of human behavior tie into options, but I would say it has something to do with attention anomalies and salience. The psychologists talk about this, that people make mistakes very commonly in what they pay attention to, what strikes their fancy or their imagination. Salience is something psychologists also talk about, that certain kinds of events, maybe it's similar to salient events are events that tend to attract attention, tend to be remembered. Now, when you think of options, a lot of options are what are called incentive options, okay? And when you get your first job, you may discover this. They'll give you options to buy shares in the company you work for. Why do they do that? I think it's because of certain human behavioral traits that I mentioned here, your attention and your salience, but it's not necessarily very expensive for a company to give you options to buy shares in the company, but it puts you in a situation where you start to pay attention to the value of the company. It becomes salient for you, and you start hoping that the price of the company will go up because you have options to buy it at a strike price. You hope that the company's price per share goes above your strike price because then your options are worth something. They're in the money. So it may change your motivation and your morale at work, or sense of identity with the company. All these sorts of things figure in. And so that's why we have incentive options. They can also give you peace of mind. Insurance is actually related to options in the sense that when you buy insurance on your house, it's like buying a put option on your house, although it may be not directly connected to the home's value, but right? When you buy an insurance policy on your house and the house burns down, you collect on the insurance policy. Well, the price of your house fell to zero. If you had bought a put option on the house, it would do the same thing, right? You would have an option to sell it at a high price, something that's now worthless. So insurance is like options. And insurance gives you peace of mind. And so people think in certain repetitive patterns, and one of them is that I'd like to not worry about something. So I can get peace of mind by not, if I have a put option on something that I might otherwise worry about. All right, maybe that's enough of an introduction, but I've given you both theoretical reasons for options and behavioral reasons. I think of them as basically inevitable. You may have people advising you not to bother with options markets, and that might be right for you in a sense, but I think that they're always going to be with us, and so it's something that we have to understand. So I have a newspaper clipping that I took. I cut it out. I've been teaching this course for over 20 years, so sometimes I don't update my newspaper clippings. I have a newspaper clipping from the options page that I made in 2002, okay? So that's 9 years ago. But I can't update it anymore because newspapers don't print option prices anymore, so I could go on some electronic trade account and get an updated option page. But why don't we just stick with the Wall Street Journal? So this is a clipping from the Wall Street Journal, April 2002, when they used to have an options page, okay? And I just picked America Online just as, I don't know why, it's an interesting company. Do you remember America Online? Web presence. It used to be bigger than it is now. And actually in 2000, America Online merged with Time Warner, okay? And so we actually have two different rows corresponding. Up there, well, forget ACE Limited. The second row says AOL.TW. That's America Online, Time Warner, the merged company. And then below that, they have America Online itself. These were options that were issued before the merger, and they apparently are being exercised in terms of the same AOL, Time Warner stock. AOL, by the way, was spun off by Time Warner last year, so they had a divorce. They were married in 2000, they were divorced in 2010. So you can get back to AOL options without now. But so anyway, under every, it shows the price of the share at $21.85 a share. So you can take any of these rows, and it shows you for various strike prices what the options prices are. So let's go to the top row. A strike price of 20, expiring in May of 2002, which is like 1 month into the future. Remember, it's April 2002 right now. The volume is the number of options that were traded yesterday, and the $2.55 up there is the price of a call option. The last price, the last option to be traded yesterday. This is the morning paper. It's reporting on yesterday morning's prices. And then there's put options traded. A lot more puts were traded on that day. There were 2,000 put options traded on that day in April 2002. And the last price of the put option was 85 cents. So you see what the... So for 85 cents, you could buy the right to sell a share of AOL Time Warner at $20. Okay. And similarly, you could buy the right to buy it at $20 for $2.55. So these are different strike prices and different exercise dates. This one is, which one you can pick. This one, I can reach it, is to buy at what's a call, $25 strike price. Cost you 45 cents to buy that. But if you want to buy a put, it costs you $3.60. And we want to try to understand these prices. Okay, that's the purpose here. Let me say one thing more before I get into that. This is presented for the potential buyer. Okay, these are options prices. There's also the seller of the option. They're called the writer of the option. I gave you an example before when I talked about the farmer and you thinking of building a supermarket. So you are the buyer of the option, and the farmer is the writer of the option. The farmer is writing the option to you. You could also consider buying an option from someone else who's not even the farmer, right? It could be some speculator. You don't have to go to the farmer. You could go to somebody else and say, I'd like to buy an option on that farm over there. And someone say, sure, I'll sell you an option on it. And then I'm good for it. That means I have to go and buy it at whatever price from the farmer. Maybe that's not such a good idea. He might sense my urgency to buy it. But if it's a stock, someone can write an option who doesn't even own the stock. And so that's called a naked seller of an option. Okay? Neither the buyer nor the seller ever have to trade in the stock. This is a market by itself. You know, you could buy an option and then you could sell it before as an option without ever exercising it. So the writer could write an option and then buy an option to cancel it out later and then essentially get out of that contract. So the option becomes a market of its own, where prices of options start to look like an independent market. And this is called a derivatives market, because there's an underlying stock price, but this is a derivative of the stock price. They were first traded. The first options exchange was the Chicago Board Options Exchange, which came in 1973. Before that, the options were traded, but they were traded through brokers, and they didn't have the same presence. You didn't see all these options prices in newspapers. It's when they opened a market for options that the options trading became a big thing. So options markets are relatively new. I mean, if you consider 73 new, you weren't born then, but it's not really that long ago. Since then, there are many more options exchanges, but CBOE is the first one. They're now all over the world, and we also have options on futures. And so futures exchanges now routinely trade options on their futures contracts. So that's a derivative on a derivative, but it's done. Okay, so let me draw a simple picture of option pricing. So this is the stock price, and this is the option price. Okay, and I'm going to mark here the exercise price. Then let's look at the exercise date, the last day. Okay, the option is about to expire, and this is your last chance to buy the stock. Then it doesn't matter on that day whether it's an American or European option. They're both the same on the last day. What is the price of the option as a function of the stock price? Well, if the stock price is less than the exercise price, the option is worthless, right? It will not be exercised. You won't exercise an option to buy it for more than you could just buy it on the market, right? Did I not say call? Yes. I'll put it up here. We're talking about call options. Thank you. But if it's above the exercise price, this is a 45-degree angle. That's in line with the slope of 1. The option price rises with the stock price. In fact, it just equals the stock price minus the exercise price, right? So this region we say is out of the money. The option is out of the money when its price for a call is less than the exercise price. Here it's in the money. I'll put it up here, in the money. And then on the exercise date, it will always equal the stock price minus the exercise price. So it's very simple. Now, one confusion that's often made, I gave the example of building a shopping center or a supermarket on a farm. Now, someone might think that you buy an option on it so that you can think about it and make up your mind later. Well, in a sense, you could do that. But the thing is, you will exercise the option whether or not you build the shopping mall or the supermarket if it's in the money, right? Suppose you changed your mind and I don't want to build a supermarket. But I'm sitting on an option that I bought to buy his land for a price which is less than the market price for it. Of course I'll buy it. So you're going to buy it whether you build a shopping center or not. You always exercise the option if it's in the money on the last day. That's an assumption. I mean, you could not, I suppose, if you like the farmer and you want to be a nice guy. I don't know. But usually it's all about, what it is a nonlinear relation between the stock price and the derivative. So the derivative is a broken straight line function of the stock price. Whereas all the portfolios we construct are linear. They're straight lines. They don't have a break in them. So it's creating, the option creates a break in the stock, and this is why Ross emphasized that options price something very different. It's not priced in the regular. No portfolio shows you this broken straight line relation. Now I want to then talk about a put. What is a put? Let me erase where it says in and out of the money, but I'll show it. I'll do this with a dashed line so that you'll see which one is. I'm leaving the call line up. With a put is out of the money. Up here, if, I can't really show it too well, if the stock price is above the exercise price, because you're selling now, and it's in the money if the stock price is less than the exercise price. I didn't draw that very well, but that's supposed to be a 45-degree line. That's 45 45-degree angle, has a slope of -1, right? So on the exercise date. Now, it's interesting that there's a pretty simple pattern here between puts and calls. What if I buy one call and I short one put, all right? Or write a put. Same thing as writing a put and shorting a put are the same thing, all right? What does that portfolio look like? Well, if I put that portfolio together, I want to have a call plus one call minus one put, all right? Well, my portfolio relation to the stock price is going to look like that, right? It's just going to be a straight line. So my portfolio is equal, the value of my portfolio is equal to the stock price minus the exercise price. Simple as that. And my portfolio can be negative now because I've shorted something. I can have a negative portfolio value. So that's very simple. You can see that. This leads us to the put-call parity equation. Well, if a put minus a call is the same thing as the stock minus the exercise price, then the prices should add up too, right? So put-call parity. There's different ways of writing this, but it says that the stock price equals, let me see, the stock price equals the call price minus put price plus exercise price on the last day, on the exercise day, right? It's simple. This is put-call parity on the exercise date. Now let's think about some day before the exercise date. Well, you know this is going to happen on the exercise date. So any day before the exercise date, the same thing should hold, except that we've got to make this the present value, present discounted value of the exercise price. And also, we have to add in case there is any dividends paid between now and the exercise date, plus the present discounted value of dividends paid between now and the exercise date. Because the stock gets that, and the option holders don't. Okay? So that's called the put-call parity relation. And now I can cross out exercise date. This should hold on all dates. Because if it didn't hold, there would be an arbitrage, a profit opportunity. So it should hold on this page, except for minor failures to hold. It should hold approximately on this page. So let me give you one example. See if it holds. Let's consider the one that I can reach. Let's see. The strike price. Okay, what is the, this is the stock price. So what do I have? The biggest thing here is the strike price, exercise price. So we want to do $25, we'll do this line, $25 plus 45 cents minus $3.60. And I'm assuming there's no dividend paid between now and May. Comes out very close to 21.85. I can't do the arithmetic in my head, but it may not hold exactly because these prices may not all have been quoted at exactly the same time, and there's some transaction costs that limit this. Do you see that now? So because of put-call parity relation, the Wall Street Journal didn't even need to bother to put the put prices in because you can get one from the other. But they do put them in just because people like to see them, and well, some people might be trying to profit from the put-call parity arbitrage. But for our purposes, we only have to do call pricing. Once we've got call pricing, we've got put prices. So I just use the put-call parity relation, and I get put prices. So now let's think about how you would price puts. The price of a put is, let's just, we know what it is on the exercise date, right? I'm going to forget the dash lines. There's no dash lines here anymore. We're just talking about call prices. All right, so what is the price of, so this shows the price of a put on the last day, of a call on the last day. Now, what about an earlier day? Well, the price of a call can never be negative, right? So the call price has to be above this line. It can never be worth less than the stock price minus the exercise price before the, even before the date. And also, it can't be worth more than the stock price itself. I'll draw a 45-degree line from the origin. So it's kind of obvious that that's supposed to be parallel to that. It's obvious that the call price has to be above this broken straight line, but not too far above it. Above this broken straight line representing the price as a function of the stock price on the last day. And the closer you get to the last day, the closer the options price will get to that curve. So on some day before the exercise date, the option price, the call option price will probably look something like that. Right? It's above the broken straight line because of option value. So think of it this way. Suppose an option is out of the money today. Well, we can see out of the money options. This is for a call, this is out of the money, right? Because the stock price is $21.85, but I've got an option to buy it for $25. All right, that's going to be worthless unless the option price goes up before it expires. So it's only worth something because there's a chance that it will be worth something on the exercise date. And what are people paying for that chance? 45 cents. Not much. Why are they paying so little? Well, you could say intuitively, it's because it's pretty far. $21.85 is pretty far from $25. And this option only has a month to go. What's the chances that the price will go up that much? Well, there is a chance, but it's not that big. So I'm only willing to pay 45 cents to buy an option like that. So we're somewhere like here on that row that I've showed you. But the reason you don't want to exercise an option early is because if you exercise it early, your value drops down to the broken straight line. Right? It's always worth more than the broken straight line indicates before the exercise date. So if you want to get your money out, sell the option. Don't exercise it early. So that's why the distinction between European and American options is not as big or as important as you might think at first. So we can just price European options, and then we can infer what other options would be, what put options would be worth. So let's now talk about pricing of options. The main pricing equation that we're going to use is the Black-Scholes option pricing equation. But before that, I wanted to just give you a simple story of options pricing, just to give you some idea how it works. And then I'm going to not actually derive the Black-Scholes formula, but I'm going to show it to you. But I'm going to tell you a simple story just to give you some intuitive feel about pricing of options. And to simplify the story, I'm going to tell a story about a world in which there's only two possible prices for the underlying stock. That makes it binomial. There's only two things that can happen. And it can either be high or low. All right? So let me get my notation. I'm going to use S as the stock price. All right? And then I'm going to assume that the stock price, that's today. And this is also a simple world in that there's only one day. The option expires tomorrow. There's only one more price we're going to see. So the stock is either going to go up or down. So U is equal to 1 plus the fraction up that it goes up. U stands for up. And D is down, is 1 plus the fraction down. So that means that the stock price either becomes SU, which means it goes up by a fraction, multiple U, or it is SD, which means it goes down by a multiple D. And that's all we know. Okay. Now we have a call option called C, the price of the call. We're going to try to derive what that is. But we know from our broken straight line analysis, we know what CU is, the price if the stock goes up, and we know what CD is the price if down. Okay? So suppose the option has exercise price E. All right. Now understand this world? Simple story. Now what I want to do is consider a portfolio of both the stock and the option that is riskless. And I'm going to buy a number of options equal to H. H is the hedge ratio, which is the number of shares sold, of shares purchased per option sold. I'm going to sell a call option to hedge the stock price, to reduce the risk of the stock price. Okay, and so hedge ratio is shares sold, shares purchased over options. Each option is to buy one share. Okay, so what I'm going to do is write one call and buy 8 shares. So let me erase this and start over again. I'm on my way to deriving the option price for you. And it's a little bit of math, but we'll get. Okay, so I'm going to write one call and buy 8 shares. Okay, If the stock goes up, if we discover we're in an up world next period, my portfolio is worth UHS minus C sub U, right? Because the share price goes from S to US, and I've got H shares, and I've written a call, so I have to pay C sub U. If it's down, then my portfolio is DHS minus C sub D. Okay? This is simple enough? Now what I want to do is eliminate all risk. So that means I want to choose H so that these two numbers are the same. And if I do that, I've got a riskless investment. All right? So set these equal to each other. And that implies something about H. We can derive what H is. If I just put these two equal to each other and solve for H, and I get H equals C sub U minus C sub D all over U minus D S. Okay? So I've been able to put together a portfolio of the stock and the option that has zero risk. It's going to, if I do this, if I hold this amount of shares in my portfolio, I've got a riskless portfolio. So that means that the riskless portfolio has to earn the riskless rate, right? It's the same thing as a riskless rate, so it has to earn that. If I can erase this now, I'm almost there to option pricing. The option pricing then says that since I've derived what H is, the portfolio has to be worth 1 plus the interest rate times what I put in, which is HS minus C. And that has to equal the value of the portfolio at the end, which is either U HS minus C sub U or D HS minus C sub D, the same thing. Okay. So I've already derived what H is, and I substitute it into that, and I solve for C. So substitute H in and solve for C. And we get the call price. Okay. And it's kind of a little bit complicated, but I'll write it. The call option price has to equal 1 plus R minus D all over U minus D times C sub U over 1 plus R plus U minus 1 minus R all over U minus D times C sub D all over 1 plus R. And I'll put a box around that because that's our option price formula. Okay? Did you follow all that? This is derived, this option price formula was derived from a no arbitrage condition. Arbitrage in finance means riskless profit opportunity. And the no arbitrage condition says it's never possible to make more than the riskless rate, risklessly. All right? If I could, suppose I had some way, suppose the riskless rate is 5% and I can make 6% risklessly. Then I will borrow at the riskless rate and put it into the 6% opportunity, and I'll do that till kingdom come. There's no limit to how much I'll do that. I'll do it forever. And so it can't, it's too much of a profit opportunity to ever happen. So one of the most powerful insights of theoretical finance is that the no arbitrage condition should hold. It's like saying there are no $10 bills on the pavement. When you walk down the street and you see a $10 bill lying there on the street, your first thought ought to be, are my eyes deceiving me? Because somebody else would have picked it up if it were there. Well, how can it be there? I once actually had that experience. I was walking down the street in New York, and I saw it was actually a $5 bill. It was just lying there on the street. And so I reached down to pick it up, and then suddenly it disappeared. And it was people on one of the stoops of one of these New York townhouses playing a game. They tied a string to a $5 bill, and they would leave it on the street and watch people reach for it, and they'd snatch it away. That's the only time in my life I ever saw a $5 bill on the pavement. And so, it sounds like a pretty good assumption that if you see one, it isn't real. And that's all this is saying, that if the option price didn't follow this formula, something would be wrong. And so it had better follow this formula. Now, that is the basic core option theory. Now, the interesting thing about this theory is I didn't use the probability of up and the probability of down. So somebody said, wait a minute. My whole intuition about options is I buy an option because it might be in the money. And when I was just describing here, this is 45 cents. I said, that's not much because it probably won't. It probably won't exceed $25. It's so far below it. So it seems like the options should really be fundamentally tied to the probability of success. But it's not here at all. There's no probability in it. You saw me derive it. Was I tricking you? Well, I wasn't. I mean, I tell you, I don't play tricks. This is absolutely right. You don't need to know the probability that it's in the money to price an option. And because you can price it out of pure no arbitrage condition. So that leads me then to the famous formula for options pricing, the Black-Scholes option pricing formula, which looks completely different from that, but it's a kindred because it relies on the same theory. And there it is. This was derived in the late 70s by Fisher Black, or maybe early 70s, by Fisher Black, who was at MIT at the time, I think, but later went to Goldman Sachs, and Myron Scholes, who is now in San Francisco, doing very well. I see him at our Chicago Mercantile Exchange meetings. Fisher Black passed away, but so it doesn't have the probability that the option is in the money either, but it looks a little different. It looks totally different from the formula that I wrote over there. The call price is equal to the share price S times n of D1, where D1 is this equation, minus e to the minus r, the interest rate, times time to maturity, T, times the exercise price times n of D2, where this is D2. And the n function is the cumulative normal distribution function. Right. I'm not going to derive all that because it involves what's called the calculus of variations. I don't think most of you have learned that. In ordinary calculus, we have what's called differentials, dy, dx, etc. Those are fixed numbers in ordinary calculus. In the mid-20th century, mathematicians, notably the Japanese mathematician Ito, developed a random version of calculus where dx and dy are random variables. That's called the stochastic calculus. But I'm not going to use that. I'm not going to derive this. But you can see how to price an option using Black-Scholes. But Black-Scholes is derived again by the no arbitrage condition, and it doesn't have the probability. Oh, the other variable that's significant here is sigma, which is the standard deviation of the change in the stock price. So once we put that in, someone could say, well, but probabilities are getting in through the back door because this is really a probability-weighted sum of the changes in stock prices. Well, probabilities were not really in here at all, but maybe there's something like standard deviation even in this equation because we had CU and CD, and that gives you some sense of the variability. But I'm going to leave this equation just for you to look at. And but what it does do is it shows the option price as a nice curvilinear relationship, just like the one I drew by hand, which then, as time to exercise goes down, as we get close to the exercise date, that curve eventually coincides with the broken straight line. So now I wanted to tell you about implied volatility. This equation can be used either of two ways. The most normal way to do it, to use this equation, is to get the price that you think is the right price for an option, to decide whether I'm paying too much or too little for an option. So with this formula, I can plug in all the numbers. To use this formula, I have to know what the stock price is, that's S, I have to know what the exercise price is, and I have to know what the time to maturity. These are all specified by the stock price in the contract. I have to know what the interest rate is. And if I also have some idea of the standard deviation of the change in the option, of the stock price, then I can get an option price. But I can also turn it around if I already know what the option is selling for in the market, and I can infer what the implied sigma is, right? Because all the other numbers in the Black-Scholes formula are clear. They're in the newspaper, or they're in the option contract. There's this one hard to pin down variable. What is the variability of the stock price? And so what people often use the Black-Scholes formula to is to invert it and calculate the implied volatility of stock prices. So when call option prices are high, why is that? Why are they high relative to other times? Well, it must be that people think, and going back to the old interpretation, that the probability of exercise is high. Right? If an out-of-the-money call is valuable, it must be people think that sigma is high. So let's actually solve for how high that is. I can't actually solve this equation. I have to do it numerically. But I can calculate for any call price, given the stock price, exercise price, time to maturity, and interest rate, I can calculate what volatility would imply that stock price. And so that's where we are with Black-Scholes. So implied volatility is the options market's opinion as to how variable the stock market will be between now and the exercise date. So one thing we can do is compute implied volatility. And I have that here on this chart here. What I have here from 1986 to the present with the blue line is the VIX, VIX, which is computed now by the Chicago Board Options Exchange. When the CBOE was founded, they didn't know how to do this. Black and Scholes invented their equation in response to the founding of the CBOE. And now the CBOE publishes the VIX. And you get on their website, that's where I got this, off their website, cboe.com. And so they have computed, based on the front month option, the near options, what the market thought the volatility, what the options market thought the volatility of the stock market was. That's the blue line. And you can see it had a lot of changes through time. So that means that options prices were revealing something about the volatility of the stock market. Now, the blue line is from the Chicago Board Options Exchange. What I did, and I calculated this myself, is the orange line is the standard deviation of actual stock prices over the preceding year of monthly changes annualized. That's actual volatility, but it's actual past volatility. Let's make it clear what this is. What the VIX is the sigma in the Black-Scholes equation, but it is in effect the market's expected standard deviation of stock prices. And to get it more precise, it's the standard deviation of the S&P 500 stock price index for 1 month multiplied by the square root of 12, because they want to annualize it. It's for the next month. So it's, why do they multiply by the square root of 12? Well, that's because, remember the square root rule. These stock prices are essentially independent of each other month to month. So the standard deviation of the sum of 12 months is going to be a square root of 12 times the standard deviation of 1 month. So, and this is in percent per year. So that means that the implied volatility in 1986 was 20%. And then it shot way up to 60%, unimaginably. In fact, that might be the record high. I can't quite tell from here. Remember I told you the story of the 1987 stock market crash? The stock market fell over 22% in 1 day. Well, actually, on the S&P, it was only 20%, but a lot in 1 day. It really spooked the options markets. So the call option prices went way up, thinking that there's some big volatility here. We don't know which way it'll be next. Maybe it'll be up, maybe it'll be down. It pushed the implied volatility temporarily up to a huge level. It came right back down. My actual volatility, now I calculated this for each date as the volatility of the market over the preceding year. Well, since I put October 1987 in my formula, I got a jump up in actual volatility, but not all as big as the options market did. So the options market is looking ahead, and I have no way to look ahead other than to look at the options market. So to get my actual volatility, I was obliged to look at volatility in the past. And it went up because of the 1987 volatility, but not so much. So what this means is that in 1987, people really panicked. They thought something was really going on in the stock market. They didn't know what it was, and they were really worried. And that's why we see this spike in implied volatility. There's a couple other spikes that I've noted. The Asian financial crisis occurred in the mid-1990s. Now, that is something that was primarily Asian, but it got people anxious over here as well. It was, Korea, Taiwan, Indonesia, Hong Kong. These countries had huge turmoil. But it came over here in the form of a sudden spike in expected volatility. People thought things could really happen here. So all the option prices got more valuable. And then there's this spike. This is the one that you remember. This is the financial crisis that occurred in the last few years. Notably, it peaks in the fall of 2008, which was the real crisis when Lehman Brothers collapsed. And it created a crisis all over the world. There was a sharp and sudden, terrible event. And you can see that actual volatility shot up to the highest since 1986 as well at that time. So implied volatility, you can't ask easily from this chart whether it was right or wrong. People were responding to information, and the response felt its way into options prices. There's no way to find out ex post whether they were right to be worried about that, but they were worried about these events, and it led to big jumps in options prices. Now, I wanted to show the same chart going back even further, but I can't do it with options prices because I can show volatility earlier, but I can't show implied volatility before around 1986 because the options markets weren't developed yet. But I computed an actual S&P composite volatility. Well, in my chart title, I said S&P 500. The Standard & Poor's 500 stock price index technically starts in 1957, but I've got what they call the Standard & Poor's composite back to 1871. And so these are the actual moving standard deviations of stock prices all the way back to the beginnings of the stock market in the U.S. Well, not the very beginnings, but the earliest that we can get consistent data for on a monthly basis. And you can see, this goes back further than the other chart. You can see that the actual volatility of stock prices has been, except for one big event called the Great Depression of the 1930s has been remarkably stable, right? The volatility in the late 20th century, early 21st century is just about exactly the same as the volatility in the 19th century. It's interesting how stable these patterns are. There was this one really anomalous event, and it just sticks out, and that is the Great Depression. 1929 precedes it. It's somewhere in here. But somehow people got really rattled by the 1929 stock market crash. And not just in the US, this is US data, but you'll find this all over the world. It led to a full decade of tremendous stock market volatility around the world that has never been repeated since. The recent financial crisis has the second highest volatility after the Great Depression. This isn't long ago. This is well within your memories. It's just a few years ago, we had another huge impact on volatility. And as you saw in the preceding slide, it had a big impact on implied volatility as well. So I think that we had a near miss of another depression. It's really scary what happened in this crisis. Well, also shown here is the first oil crisis, which we talked about in 1974, when oil prices, they'd been locked into a pattern because of the stabilization done by the Texas Railroad Commission. But when that broke, when OPEC first flexed its muscles, it created a sense of new reality, and it caused fear, and it caused a big spike up in volatility of the stock market. But not quite as big as the current financial crisis. So I think this is an interesting chart to me, because it shows that financial markets, well, a lot of things I learned from this chart, and maybe I'll just conclude with some thoughts about this. But what I learned from this chart is that somehow financial markets are very stable for a long time. So it would seem like it wouldn't be that much of an extrapolation. When are you people going to retire? You picked a retirement date yet? Well, let's say a half century from now, okay? So that'd be 2060, something like that. So you're going to retire out here, all right? Your whole life is in here. What do you think volatility is going to do over that whole period? Well, just judging from the plot, it's probably pretty similar, right? I mean, that's not much more history compared to what we've already seen. Probably just going to keep doing this. But there's this risk of something like this happening again. And we saw a near miss here, but we didn't. I think this plot encourages me to think that maybe outliers or fat tails or black swan events are the big disruptor to economic theory. Black Scholes is not a black swan theory. It assumes normality of distributions. And so it's not always reliable. This leads me to think that option pricing theory, I've presented a theory, the Black Scholes theory is very elegant and a very useful tool, especially useful when things behave normally. But I think one always has to keep in the back of one's mind the risk of sudden major changes like we've seen here. So let me just give some final thoughts about options. I launched this lecture by saying they're very important, and they affect our lives in many ways. I've been trying to campaign for the expansion of our financial markets. Working with my colleagues and the Chicago Mercantile Exchange, we launched options in 2006 on single-family homes in the United States. We were hoping that people would buy put options to protect themselves against home price declines, but the market never took off. We have since seen huge human suffering because of the failure of people to protect themselves against home price declines. There are various noises that were made by people in power that suggested that maybe something could be done. President Obama proposed something called Home Price Protection Program, and it sounded like a put option program. But actually, it was a much more subtle program than that. It was a program to incentivize mortgage originators to do workouts on mortgages if the mortgages would default, if home prices were to fall. And nothing really happened with it. The president can't get things started either, always. I've been proposing that mortgages should have put options on the house attached to them. When you buy a house, get a mortgage, you should automatically get a put option. I've got a new paper on that. But these are kind of futuristic things at the moment. But my sense, I'm just saying this at the end just to try to impress on you what I think is the real importance of options markets. People don't manage risks well in the present world. Having options or insurance-like contracts of an expanded nature will help people manage their risks better, and it will make for a better world. Okay, that's, I'll see you on Monday. I already had a few lectures ago about banks. So what are central banks? Well, today they're very special government banks that are responsible for the currency. the money. And so every country in the world has a paper money that has the name of their central bank on it. But I wanted to take as you know, I like to understand origins of things, and I wanted to take it back to the beginnings of central banking so we'll understand better what the institution is. And I wanted to bring up first the theme of this course, which is that financial innovation or invention is an important process that is not unlike engineering invention. When somebody gets an idea and it's proven to work, it gets copied all over the world. That's the way the human species is. We all have the same kind of cars, we all have the same kind of airplanes. Why? Not because we're copycats, but because someone has figured out something that works. And of course, everyone copies it. And I think the same thing is true with central banks. So I wanted to get to the history of central banks and to go back first to the first central bank. Then I'll bring it all the way up to the modern times, where the recent financial crisis, during the crisis, the actions of the world's central banks was extremely important in preventing what might have been another Great Depression. So these institutions have become of fundamental importance. So remember the story I told you in our banking lecture about how banks got started in the UK. They'd already been seen earlier in other places, but the really modern banking institution is traced to the goldsmith bankers. Okay, so people there were goldsmiths who made gold jewelry, and people found that since they had a safe or they had a way of protecting things, they would leave their gold on deposit at the goldsmith banker, and the goldsmith banker would give you a little piece of paper indicating that you could anytime come back to the goldsmith and claim this amount of gold. And then the pieces of paper started circulating as paper money. And that's how it all started. Unregulated, nothing to do with the government. It was just private businesses. And that system, paper money backed by gold, lasted until the 1970s. Amazing. Well, it wasn't always gold. It was bimetallic. There would be gold and silver and things, or all silver. It's a long story, but we were effectively on the gold standard until just a few decades ago. But there were problems right from the beginning. And the problem was that sometimes the goldsmith bankers wouldn't make good on their pledge to redeem in gold. You'd come with your piece of paper and they'd say, I've gotten too many requests, I don't have any gold anymore. So that was the problem. So I wanted to start with the Bank of England, which was founded in 1694. And it was just a bank, but it had a special charter from the Parliament, from the British government, that gave it a monopoly on joint stock banking to start with. It would be the only bank in the United Kingdom that was allowed to issue shares and sell shares to a large number of people. There were other banks, but they were partnerships and had only a limited number of partners, so they didn't get as big. So the Bank of England became the dominant bank in the United Kingdom. And it started a practice, and this is very important historically. It realized it had a lot of power because it was the guerrilla bank, and there were a lot of little banks. And they realized soon that they could put any bank they wanted out of business whenever they felt like it. How? Well, because the Bank of England was so big, they got a lot of notes issued by these other banks. So anytime they wanted to, they could just present them all for payment. And no bank could withstand that. They didn't have enough gold on hand. So they could drive any bank to bankruptcy. But the Bank of England began to assume its role as essentially a government bank without being officially government by using a let's live and let live policy under one condition. If you are another bank in the UK, you have to keep a deposit with us, okay? And the Bank of England would tell you how much. If you didn't do that, you could be destroyed. But that created a stability to the system because the Bank of England had money to bail them out whenever they had a deposit with the Bank of England. The Bank of England required that. And so whenever a bank got in trouble, they could always take their money out of the Bank of England. So the Bank of England then would help these banks in return for their keeping a deposit, sometimes even lend more money to them. So that created a stable banking system over the centuries. So that was the model for all of the central banks of the world. They're all copies of the Bank of England. The Bank of England, by the way, was not an independent. It became a government bank. I don't know the whole history, but it wasn't really independent of the government until 1997, when the United Kingdom made it formally independent. But nonetheless, it was a model for central banking. And it was observed over much of the world. Notably, in the United States, there was a bank called the Suffolk Bank. This is much later. It was founded in 1819 in Boston. And it was a private bank, and on its own, it just decided to do the same thing that the Bank of England did. It required that all of the New England banks kept a deposit with it. And it did the same thing, and it stabilized New England from bank runs. And it lasted, the Suffolk system lasted until 1860. So you can see how central banks are inventions of people. They weren't government inventions at all. The Suffolk Bank just did this. It became a big and influential bank. And The United States in the first half of the 19th century had repeated banking crises, and there were repeated problems with the currency. It used to be that if you went to a store and you wanted to buy something, they'd say, let's see your money. You'd take out all of your money, you'd lay it down, and they'd look at it, and they'd say, well, this is Boston money, this is New Haven money, this is Hartford money. And they would pull out a book called the Banknote Reporter, and they'd say, well, our money dealers are now doing a 20% discount on Hartford money, so I'll give you 80 cents on the dollar for the Hartford money. Boston money, we're down 30% on that. What a messy system. I shouldn't mention Boston, because Boston had a good record because of the Suffolk Bank. So in other states, it was worse in other states, the further you got from Boston. So the Suffolk Bank became held up as a model of a banking system. But the US also had two banks, one called the Bank of the United States, which was founded in, I'm forgetting the year, it's not in my notes, anyone tell me when was the Bank of the United States founded? 1789, I think? And we had a second Bank of the United States, but they weren't really functioning like the Bank of England. They were maybe somewhat like them, but the banks of the United States were not really central banks, and they were not renewed. They disappeared in 1836. But the big movement in the United States, there was a lot of, because the United States didn't want the government involved in private business. They were reluctant to set up a central bank for a long time. In 1863, the U.S. passed the National Banking Act. Actually, there was a revision of it in 1864. And they tried to get some of the advantages of these central banks without actually founding one. So what they did then is they said there's a new kind of bank called a national bank, and the national bank would have a name like the First National Bank of New Haven. Every city created a bank in 1863, which was called the First National Bank of something. And the government required that they keep on deposit with the Treasury capital to back their currency. So they were called national bank notes, okay, that were issued by the banks, printed by the government, but they all looked the same except they had a different name of the different bank on them. And they had capital requirements. So the banks had to put deposits with the Treasury backing their currency. And that was a success. The United States never again had a problem with its paper money. It's always, there was never a problem of discounts anymore. All the national banks would honor each other's notes at par. And so that's when the United States had a paper money for the first time. But it didn't create a system of stable currency. There were still banking crises, but they had a different form. It wasn't a failure of the banknotes. We fixed the banknote problem in 1863. But the problem was there were still runs on banks, and there were still credit expansions and contractions that led eventually to people in the United States thinking, we've got to eventually copy the Bank of England and do the same thing here. There was a terrible banking crisis in 1893, for example, when everybody thought the banks were going to fail. Somehow they didn't worry about the currency. The national banknotes were thought to be perfectly safe. But they thought the banks weren't safe, and so there was a crisis. And it led to the Depression of the 1890s. Then there was another one in 1907 that was really bad. And so people wanted to fix somehow the system. And so that led to our current system, which has been around almost 100 years. And I call it a copy of the Bank of England, but that might not be described that way by everyone. And it's called the Federal Reserve System. All right. And that was created by an act of Congress in 1913, and it opened its doors in 1914. But the U.S., again, we always feel that we're different. We have to make it look different. We can't just copy the Bank of England. We've got to do something different. So they said, why don't we create 12 banks? That sounds more American, and have them all over the country. And so we didn't create a central bank. We have a banking system with 12 Federal Reserve banks. But of course, they decided to have a headquarters in Washington, D.C. called the Federal Reserve Board, okay? So, or the Board of Governors of the Federal Reserve System is an agency in Washington that oversees the 12 regional banks. Okay, do you know what region, which the country is divided up? What region are we in? It's Boston. This is the Boston region. So most of the money in your pocket is Boston money. It only says so now on the $1 bills, I think, but you can look and see whether where your money came from, which of the 12 banks, your currency. But the Federal Reserve System, as founded in 1913, required, just like the Bank of England, that banks have deposits, or either currency in their vault or deposits with their Federal Reserve Bank to back up their currency. And once again, if they got into trouble, they could draw on their deposits with the Federal Reserve, or even beyond that, the Federal Reserve could come to their rescue. Their they've been good banks. They've kept their deposits, just like under the Suffolk system. They've kept their deposits with the Federal Reserve. The Federal Reserve was going to help them a little bit more. And so it became known as the lender of last resort. And the system also operated something called the discount window. Now, why do they call it a window? What this is, when you people never go into a bank anymore, right? Or do you go into banks? Remember they used to have a teller, and the teller would be sitting at a sort of a table, and there's a little something. He's talking to you through a window. I guess they wanted to keep you separate from the money, so there was a window where a teller would talk to you. So the discount window was a special window at the Federal Reserve Bank for banks to come. Just like this is the metaphor anyway. I don't know if they ever had such a window. And so the bank that was in trouble could go to the discount window, and has to bring something, though. They have to bring some securities as collateral. And so the teller behind the discount window would discount the collateral brought by the bank and lend money. So it's called a discount window because you couldn't just borrow money. You had to bring some asset as collateral for the loan. So in 1913, when the Federal Reserve was founded, President Wilson, who was president, who signed the bill, was almost ecstatic. I have a quote from him, I don't remember exactly, but something like, "We have put banking crises behind us forever, and this will lead to a system of prosperity," and I can't think of all the nice words he used. People thought that now that we have adopted the British system, it ought to be smooth, and just like in Britain. There shouldn't be a problem anymore. And so we still live with that system today. I think Wilson was right. It was a big step forward. Again, it was a copying of other people's successes. Nobody knows exactly how the banking system works. There's a theory of money in banking, but it has worked in practice. And so central bankers start to become very important in modern society because they are really the keepers of the gate of the sensible lending. There is a tendency for banking systems to overlend, to create booms, and create a false prosperity for a while, and then it crashes, and we have a banking panic and a recession or a depression. So that means then the banking system has to be the source of stability and good sense. So we tend to recruit as central bankers people who are moral and stable in their lives. So it was one of our Federal Reserve chairs, William McChesney Martin, summed it up very nicely. The job of the central banker is to take away the punch bowl as soon as the party gets going. Okay, it's like a parent, right? Taking away. You can have one drink, but we're going to stop. And so that's what the central bank. See, the central bank controls the system through reserve requirements. That is how by telling the banks who are members of the system how much they have to hold in reserves, which are deposits at the central bank or currency. If they hold currency in their vaults, if it's right there, then they're okay. This term, reserve requirement, actually goes back to before the Federal Reserve, because we had in the United States, we had state banking regulators that were already imposing reserve requirements. And I haven't tracked down exactly when it began, but I think probably around 1900 in the United States, during the Progressive Era. So there are also capital requirements. And I'll come back to making a distinction between the two. Capital requirements and reserve requirements, both of those terms began to flourish around 1900, even before the Federal Reserve, with state banking regulators who were requiring both capital and reserves in the United States. I don't know the history of every other country. But after the Federal Reserve was set up in 1913, it began to take over both of these functions of setting reserve requirements and setting capital requirements. Let me go a little forward in history. The system appeared great. We had the Federal Reserve. We had now every country of the world, not just the U.S. and the U.K., virtually every country of the world had a central bank. Even communist countries, I think, had central banks. But the system broke down in 1933. Well, actually before 33, after 1929, banks started to fail. And the Federal Reserve could have bailed out the banks. In the United States, they started to fail, not the United Kingdom. But there was a banking crisis after 1929, and it reached its peak in 1933. So just before President Roosevelt took office, the banks were in total disarray. And the first thing Roosevelt did as president was to shut down the entire banking system of the United States. It was called the banking holiday because everyone was running to the bank. It was a catastrophic bank run. Everyone was failing at once. And it was quite a scary situation because nobody could get their money. The banks were all closed, all of them. And people started to run out of money. I remember that the Harvard Crimson did a poll of its students asking them how much money do you have in your pocket? And it got down to like 10 cents and 5 cents. They just spent all their money. What do you do? I mean, how can you get lunch? Well, I assume they had a cafeteria. Somehow you could still do it. You couldn't go anywhere and spend any money if you didn't have it because it was all tied up. So people started changing IOUs, and it was just a mess. The Federal Reserve didn't stop that crisis. But the Roosevelt administration did other things to prevent crises like this, notably set up the Federal Deposit Insurance Corporation. Now, this was deposit insurance had preceded the FDIC in 1933, but it had never been a success. It had been tried in a number of places. The U.S., I think, set the example for deposit insurance, and that began to augment central banking. The U.S. had not had another banking crisis since 1933 until 2007, just recently. And, well, I should say there was the saving and loan crisis, but not a big banking crisis. That is testimony to, I think, the importance of deposit insurance. But the Federal Reserve began to see its role as not so much preventing banking crises, that was always in the background, but as stabilizing the economy. And so the Fed began to think of itself as preventing the recurrence of recessions. So when the economy was overheating, the inflation was building up, the Fed would raise interest rates, and the higher interest rates would cool down the economy. And when the economy got too soft, when the unemployment rate went up, the Fed would cut interest rates, and that would encourage borrowing, encourage spending, and boost the economy. Actually, that function of the Fed goes back even before 1933. There was an economist, Charles Amos Dice, who wrote in the 1920s that the Federal Reserve is like the regulator on a steam engine. Do you know anything about steam engines? They have this thing that whirls around with two little weights, and if the steam engine gets too fast, the weights spin out by centrifugal force, and it cuts off the steam so that it doesn't overheat. The engine doesn't get going too fast. And so Dice said, the Federal Reserve is an invention. Now that is serving it's the regulator for the whole economy. And I think he was right, although it's not as accurate as a regulator on a steam engine, but it works somewhat well. I wanted to mention, every country now has a central bank, but I just wanted to mention the European Central Bank because it's quite new, and it's maybe the biggest central bank now, in the sense that I shouldn't say that. In terms, it might be the biggest central bank by some standard. There was a treaty signed at Maastricht in 1992, which led to the creation of the European Union from the European communities, and it also created a plan for a new currency called the euro, which is a European currency. The euro did not actually start until 1999, and the actual currency was not issued until 2002. So that is a relatively recent invention. The European Central Bank, or ECB, was founded in 1998. That's before the euro currency started. They created a list of countries that wanted to participate in the Eurozone. The Eurozone, not all European Union countries decided to participate in the euro. Notably, the United Kingdom had a referendum and voted against it. And to this day, they are not members of the euro. Also, Sweden, Lithuania, Latvia, Estonia, Poland, Czech Republic, Hungary, Romania, Bulgaria, and Malta are not in the Eurozone. Some of these countries that are not officially in the Eurozone use the euro unofficially. It's not their currency, but there's no law against your coming in and spending euros, so the euro seems more distributed than that. So anyway, that's the most recent central bank. But it's the same general structure. As every European country has its own central bank, like the Banco d'Italia or the Deutsche Bundesbank. But their original purpose is kind of gone because they no longer maintain a currency. There are no more Deutschmarks or Italian lira. They're all using the euro. So the real central bank is the European Central Bank in Frankfurt. led by Jean-Claude Trichet right now. So, Bank of Japan, by the way, was became independent. Mentioned that in 1997. Bank of Japan, another very important central bank. There's been a movement in the last few decades to make central banks independent. This was something that our own Federal Reserve had from the beginning. It was designed to be separate from the government. The reason was they thought that a government might want to inflate the currency. Political pressures might, at certain times, cause them to try to influence the central bank. And so the Federal Reserve was set up so that the members of the Board of Governors had 14-year terms. They couldn't be kicked out except for impeachment offenses. And so the government couldn't control the central bank. The independent central bank has been very important. What tends to happen is you bring people in who've had long careers in banking, who have a reputation for integrity, and you tell them that you are the custodian of the currency. You bring in people who believe in the importance of a stable currency, and then you give them a 14-year term, and they're there. It's like the Supreme Court almost. You can't kick them out. And some people think that's why the U.S. has had such a stable price level, because of our independent central bank. So many countries have fallen into inflation that has undermined the currency, but the U.S. hasn't. And I think that's why there has been a move to copy the independent central bank. Okay, now I wanted to talk now about specifics of what the central bank does. Notably, the Federal Reserve System has a committee called the Federal Open Markets Committee, FOMC, Federal Open Markets Committee, that meets around once a month. And they issue a statement every time they meet. And as it is now, actually FOMC doesn't go back to 1913, but I'm talking about the Federal Reserve as it is now. This committee decides on a range for an interest rate called the federal funds rate. And the federal funds rate is an overnight interest rate that is charged on loans between banks and some other financial institutions. You generally would not have access to the federal funds rate. Now, you probably don't need it because you don't need an overnight loan anyway, right? Most of us would borrow money for more than one night. But banks, for various reasons, do this lending and borrowing every day, at least under normal circumstances. So we have an overnight interest rate, okay? There's also longer federal funds, but we're emphasizing the overnight rate. And it's unsecured. This is just an unsecured, there's no collateral. It's an unsecured loan between banks. So the interest rate reflects some risk, negligible risk usually, because banks trust each other at least overnight, right? They know pretty much they're going to get paid back. And the current federal funds rate in the United States is 0.13% as of last Friday. That's 13 basis points, so it's virtually zero. This is a policy decision of the Federal Open Markets Committee. They have decided that the range for the federal funds rate will be between 0 and 25 basis points. So it, as of last Friday, was exactly in the middle of their range. The FOMC uses its decisions to set the federal funds rate as a way of stabilizing the economy. This is the regulator that Dice talked about. Right now, they've set it virtually at zero because the economy is so weak. The unemployment rate last week was 8.8%, extremely high. And so the Federal Reserve is not worried about inflation now. It's worried about high unemployment. And it's pushed it about as close to zero as it can get it. It can't go below zero because you can't have negative interest rates. No one would lend at a negative interest rate. So that's where we are. And now, I wanted to just tell you about an interesting development that came in just in 2008. The reserve, I mentioned that banks hold reserve accounts at the Federal Reserve. Traditionally, those accounts were not interest paying. I mean, banks had to either hold money or an account at the Federal Reserve for their reserves, and neither of them pay interest, right? If you hold money, you don't get any interest. If you actually have currency in your vault, you don't get interest. And until recently, banks didn't get interest on their deposits at the Federal Reserve. But that all changed in 2008 with the Emergency Economic Stabilization Act that President George Bush signed, ESA as it's called. And ESA allowed the Federal Reserve to pay interest on the reserves held in the accounts at the Federal Reserve. Okay? So the Fed has a policy now of paying interest on reserve balances. You see what I'm saying? I don't know what the Suffolk Bank did or the Bank of England did, but I know what the Fed is doing now. If a member bank puts money in deposit with the Federal Reserve, they will get an interest rate. And you can find out what the interest rate is by going to the Federal Reserve website. And right now, it is 0.25%. And so that's an important policy change, because now it encourages the holding of reserves. Now, some people look at this and ask this question. Here's the federal funds rate. Why isn't it the same as the interest on reserves? Interesting question. Why would anybody borrow? Why would any bank invest in the federal funds market if they can get a higher interest rate by just holding a reserve at the Federal Reserve? There's been a lot of discussion of why that is. Now, it's a new phenomenon because the interest on reserves goes back only less than 3 years. I think the simplest answer to the question is that member banks of the Federal Reserve System have stopped lending on the federal funds market, basically. They just leave it in reserves because that's a higher interest rate. So who is lending at this? It turns out that there are some people, notably the government-sponsored enterprises like Fannie and Freddie, that are not eligible for interest on reserves. So they have taken over the federal funds market. The reason the Fed added interest on reserves is to create another tool of monetary policy. There's a lot of concern that after this crisis is over, there will be a sudden surge of inflation. And let me come back to that. Basically, what the Fed has a new tool is, if that happens, to raise the interest on reserves, and that will help contract the economy instantly, very, very rapidly. The way the Fed controls the federal funds rate, and has been doing for years, is by buying and selling treasury bills on the open market, by affecting the supply and demand for short-term credit. And that indirectly, they don't actually deal in the federal funds market. They deal in the treasury bill market. But since those markets are interlinked, they indirectly target the federal funds rate. So that's the old way of trading in the federal funds market, not in the federal funds market, trading in the short-term treasury market through the New York Fed. But now they have a new tool. So we're entering a whole new regime of monetary policy. Okay, so I want to talk about reserve requirements a little bit more, and what those are. So the Federal Reserve has the authority to set the amount of reserves that a bank holds. I wanted to make clear the distinction between reserve requirements and capital requirements. So, okay, the Federal Reserve has what's called Regulation D, which specifies how much banks have to hold as a function of their liabilities. And as of right now, the reserve requirements are 10% of transaction accounts. Okay, that means that a bank has to total up all of the transaction accounts, and that consists of checking accounts, what are the NOW accounts, and ATS accounts. Their transactions accounts are accounts like checks that people have a deposit in the bank that they'll use for spending, and those are instantly withdrawable. Okay. In contrast, there's something called time deposits. Those are savings accounts, and the bank does not have to give you the money immediately. In other words, if you go to your checking account and say, I want my money, it's a transaction account, they have to give it to you instantly. That's the rule. But if you go to your saving account, they can stall, because you might not have noticed it, but it's in the fine print somewhere. This is a time deposit. So the Fed is not worried about time deposits. We're talking about reserve requirements. Reserve requirements are still based on the old theory that we're trying to prevent bank runs. Okay, and so we don't want people to, don't want there to be a run on banks where people panic and try to withdraw their money all at once. So we want to make sure that banks have enough reserves. And the Fed currently thinks 10% ought to be enough. For time deposits, it's 0. You don't have to put any money on reserve for time deposit. Why does the Fed think that? Because you've got 60, 90 days or a year to pay the person back. So they can't run on you. So we don't require any reserve requirements against time deposits. But it's 10% for a transaction account, which is substantial, because they're still worried about this. Okay, so this is the situation. We used to emphasize in lectures about central banking the so-called money multiplier. Okay, the money multiplier, well, it's complicated, but the simplest thing is it might be 1 over the reserve requirement. It's not exactly that, but if the reserve requirement is 10%, then the total amount of deposits that banks can issue is going to be 10 times the amount of currency and deposits they have at the Federal Reserve. So that means the reserve requirements would fix the money supply under the old theory, because if the high-powered money is the currency plus deposits at the Federal Reserve, that's reserves, and if the reserve requirement is 10% and banks want to just meet that requirement and nothing more, they're going to have 10 times as much deposits, right, as there are reserves. So I'm oversimplifying the money multiplier. But I'm telling you that at the moment in history it's irrelevant, because banks are holding excess reserves. The world has changed. Just a few years ago, before this financial crisis, banks didn't want to hold excess reserves. And so there were hardly any excess reserves. Why? Because they don't get any interest on them, all right? And so banks didn't hold excess reserves. So the money market multiplier theory would work, because the amount of reserve was just about exactly equal to 10% of transactions account. I'm oversimplifying, but something like that was true. But now they're paying 25 basis points on reserves. So that's a lot more than you can get investing in the federal funds market. So banks are just perfectly happy to hold excess reserves. So the excess reserves now are over, I think it's 1.2 trillion. It's huge because of interest on reserves. And I don't have the exact number, but something has fundamentally changed in just the last few years. So reserve requirements, they must hold for some banks, but for most banks, they don't even look at reserve requirements anymore. What do I care? I'm so happy to hold reserves. I'll hold way more than they require. So reserve requirements are non-binding for most banks now. So it's a different world. This brings us then to capital requirements. So in the world, history has always changed. The world, as of a few years ago, everyone emphasized reserve requirements, and those were the requirements that had as its motive preventing bank runs. But we're not going to have a bank run now when these banks have over $1 trillion just sitting there. They're holding so much that it's not an issue right now. So something else has taken the center stage, and that is capital requirements, which we talked about last time. So capital requirements are different from reserve requirements. I just defined reserve requirements were a fraction of the transaction accounts. They were defined by a liability of the bank. A transaction account is like a checking account. It's some money that the bank owes to other people. And we have this requirement that 10% of that is the reserve requirement. But capital requirements are different, and they're more likely to be binding these days. And these were emphasized in Basel III, which we talked about before. Basel III is not yet in force. It's going to take a long time. Basel III has a phase-in period that's going to take until, I think it's 2019. But there's a lot of talk now about trying to get Basel III phased in. But remember, we talked about risk-weighted assets. Nowadays, banks have to hold capital as a fraction of their risk-weighted assets. So right now, the countries of the world, they've agreed. The G20 countries have agreed on Basel III. But each country has to decide on the implementation of Basel III. The United States, in particular, is having problems with Basel III because Basel III refers to credit ratings in many places. But the Dodd-Frank Act of 2010 abolishes credit ratings. The government will no longer make any use in any regulation of credit ratings. Remember what credit ratings are. Moody's and Standard & Poor's are the two best-known credit rating agencies. The government, the SEC, starting in 1975, defined what they called NRSROs. That's nationally recognized statistical rating organization, all right? And that included Moody's, which was founded in about 1900, and Standard & Poor's, which was a result of the merger of Standard Statistical Association and Poor's a little bit after 1900. They're venerable old institutions that give a risk rating for securities. For example, Moody's will give its best securities a AAA rating, okay? That means Moody's thinks they'll never default. Yale University is rated AAA by Moody's, for example. But they go, if they don't like you quite as much, they'll downrate you to AA. Or if they don't like you even more, you're only A. And then, God forbid, you go down into the Bs. It's like, in fact, Moody, John Moody, in his book, acknowledges that it was just, he took the same grading system that he got in college. I don't know why, it's a little different. You don't get a AAA grade here, do you? I've never given a AAA. But that's how Moody saw it. And so it survives like letter grades to securities. Well, Moody did that in 1900. And if you read his autobiography, people said, you're crazy. How can you give a grade to a security? It seemed like a wild idea. But he stuck with it. And over the years, people began to believe in them more and more. So it led to an idea that we fully understand the risk of securities. And so there was a complacency set in. And the government started to recognize these NRSROs as if they were proclaimers of God's truth. And they started all kinds of regulations, said what your capital had to be depending on the rating of various assets you hold. But the whole thing collapsed in the recent financial crisis because some AAA securities lost almost everything. So the rating agencies made a big problem issue. And so Congress has now said nobody can make any regulation based on ratings of the NRSROs. But Basel III people didn't get the message. Well, they're not America, they're international, and they still believe in them. I think it's a little bit difficult to know how to handle risk. This is the fundamental problem. And it would be nice if Moody's and S&P could tell us, but the problem is that they missed this whole crisis. They didn't see it coming. And why didn't they? Well, that's a deep issue, but that's what people are wrestling with right now. So the U.S. has to figure out what to do to reinterpret the Basel III recommendations for the United States without using any reference to Moody's and S&P. What will probably happen, I think, is that the banks will have to have their own risk committees, and they will have to come up with their own assessments of risk, and they'll be responsible for those. But what will really happen is they'll just look at the Moody's and S&P ratings, and it'll be rubber stamping them. So I don't think that there's a whole question whether Dodd-Frank will be effective in reducing our requirement. But I wanted to go over the capital requirements once again, because now they're increasingly important. And I wanted to go through just a simple example of capital requirements so that you'll understand them. And I don't think that the general public understands them very well at all. Okay, and so this is old accounting, or old finance. These requirements go back 100 years. I'm going to talk in very simple terms about them. Oversimplifying. Basel III is a complicated new agreement. It has a lot of ins and outs. But I'm just going to oversimplify it and talk about the Basel III common equity requirements that I'm going to tell a little story about founding a bank, okay? Now let's just understand how capital requirements work. So imagine that you decided to found a bank, okay? In developed countries of the world today, you can do this. You can set up your own bank. The only problem you have to get a charter. You have to apply for a charter. You have to decide whether you're a national bank in the United States or some other kind of bank. But you get a charter, and you open your doors. Now you've got to start complying with capital requirements. But let's say you do that, all right? You find that there's an empty bank building downtown, all right? You rent the building, you go through the paperwork, and you set up your bank, and you open the doors, and now we have one of those windows with a teller and inviting deposits, okay? So I'm going to tell a story which is oversimplified and maybe a little bit. Let's say that you open your doors and someone walks in with $100 and deposits it, all right? So this is your bank, or I'll say my bank, okay? The bank had, now I think regulators would require you come up with some capital first, but I'm going to tell the story. It seems to be a nicer story. You start out with deposits. Assume your regulators allowed you to start. So somebody walks in and deposits, and here's your assets, and here's your liabilities, okay? Left side is assets, right side is liabilities. So someone deposits $100 in cash to your bank, all right? So you've got an asset now of $100, okay? And you have a liability now of $100. If that's a savings account, you don't have any reserve requirements. If it's a transactions account, you have to hold $10. I've got it, right? I've got $100 sitting in my vault because the guy just gave me $100. So I'm satisfying both my reserve requirements and now am I satisfying my capital requirements? Well, I have to calculate risk-weighted assets, all right? Remember, every kind of asset has its risk. What about cash? Well, cash has a zero risk, so it has a zero risk weighting. So right now, my risk-weighted assets equals 0, okay? I've got to satisfy all the regulations that are on me. And I'm satisfying my reserve requirements, right? I've got my reserve, I've got $100. This is cash in my safe. And this is a liability. I owe $100 in the form of let's say it's a transaction account. Whenever this person comes back, I've got to pay $100, okay? All right, so my reserve requirements are satisfied because I've got more than 10% of my transactions account. My risk-weighted assets are 0. Now, Basel III says that you have to hold 4.5% of your risk-weighted assets as capital. But now, wait a minute, I have a problem. Okay. What is my capital here? I don't have any capital. I've just opened my doors, and I've got $100 in assets, $100 in liabilities. Everything looks okay from reserve requirement, but there's no capital. So what is capital? I have to issue shares to come up with capital, and I'm going to need Basel III says 4.5% common equity requirement. And they also have something called a capital conservation buffer, which is another 2.5% plus 2.5%, which you don't absolutely have to hold, but if you don't hold it, you're subject to restrictions. So I'm going to add these. This is the capital conservation buffer. I've got to hold 7% under Basel III. And I don't have any capital here, all right? So what do? I'm not in compliance, so I've got to raise capital. So what I can do is I can issue shares. I have to sell shares in the business. So all I need to do is sell well, okay, what would it be? Let's say I issue $20 in shares, okay? And then that means someone gives me more cash, right? Because someone paid for the shares. So I've now got $120. Well, I add another plus 20. So it's a total assets of 120, all held in cash. Okay, now I've got, now this is not a different kind of liability. This is common equity. And the regulators make a big distinction between this kind of liability, the transaction account, and this kind of liability, the $20. Why do they make a big distinction? Because this guy can come to the window anytime and you've got to give them $100, whenever this person asks. The shareholders have no demand on you at all. They own a share of the company. They can't come to the window and demand anything. You can just send them away. The only deal you have with shareholders is that all shareholders will receive an equal dividend if the board of directors decides to vote dividend. They're shareholders in the company. But they can't run the bank. The shareholders can't show up at the window, so there's no risk of bank runs for them. And there's no risk of problems, because if anything goes bad, you just tell the common equity guys you're out. You lost. Okay, so now what are my risk-weighted assets? They're still zero. I've got $120 in cash, zero. I don't have any, 7% times 0 is 0. So now I'm in great shape. I've satisfied both my reserve requirements and I've satisfied my Basel III capital requirements. Okay, now, so what do we do next? We created a bank, and there's no interest paid on these checking accounts, and we're not earning any interest. We've got a bank and we're satisfying the requirements, but nobody's making any money, so we've got to do something to make money. So what I'm going to do is let's say we get our board of directors meeting, the board of directors elected by the common equity shareholders, and we decide, let's make some corporate loans. So why don't we lend out all of this $100 that was cash and lend it to some business as a corporate loan, and we'll charge them interest. Now we're going to start making money. So this is no longer cash in safe. This is corporate loans. Loans to corporations to do business. All right. So there we are. Our balance sheet balances. Everything looks fine. But what is our risk-weighted asset now? Well, you remember corporate loans get 100% risk weight, because under Basel, going back to Basel I, they always thought corporate loans are risky assets. So my risk-weighted assets are now $100, okay? And 7% of $100 is $7. So hey, I'm doing fine. Now we're capitalized enough. We're in business. We're satisfying both our reserve requirements being 10%, and that's only $12. We've got it in cash. And we're satisfying our Basel III capital requirements. So everything is fine. Everything is fine, and we're in business. And we're not done yet, because our risk-weighted assets, our $7 is the capital requirement, and we've got $20 in common equity. Okay, so everything is great. This is fine. But now let's go on. Now there's a crisis, all right? Business gets bad. So the next thing that happens is 20% of my corporate loans default, okay? And so we then, it becomes clear. We have another board meeting, and someone says, I have bad news. We made $100 in corporate loans, but these guys, $20 is never going to get paid back. The borrower is out of business. So I suggest we do a write-off of our corporate loans, and let's reduce them to $80. Okay? So what happens? Now, assets have to equal liabilities. $100 is our assets now, not $120, right? Because we just lost $20. Our liabilities can't be $120, because they have to equal our assets. What gives? Well, it's the shareholders that give. So we mark down common equity to 0. And now assets and liabilities match. So now let's look at our requirements. What about our reserve requirements? Reserve requirements are fine. We're holding excess reserves. We only have to hold $10, and we've got $20 in cash. But we're no longer satisfying our capital requirements. So our bank regulator is going to shut us down unless we do something to raise capital. So how do we raise capital? That's the next step. Well, one thing we could do is we could sell some of our corporate loans, right? We could find a buyer for our corporate loans, and we could sell, say, $20 worth of them, bring this down to 60, and this would go up to 40, all right? Our risk-weighted assets would now, well, then, let me see, no, that wouldn't do it. I'm sorry, that wouldn't do it, would it? We still don't have, I'm sorry, I misspoke. We still don't have any common equity. In this case, if we don't have any common equity, we can't get out of this by selling our loans. We could have if it didn't reduce it to zero. If the common equity went down to $10, then I could sell some of my corporate loans to get out of this mess, right? But I've made it zero. So the only way out that I can do is to issue more shares. So I've got to go to my friends again and say, well, we started this bank, but we goofed up. We made bad loans, and so we've exhausted our common equity. I've got to raise more capital now. And so what you could do is get more friends to come in. Now, they might not want to do it because the previous friends just got wiped out. They lost everything, right? But you're coming in as new shareholders on top of the old. And you could then go back to where you were before by just issuing more shares. So this is the system. I think I've pretty much summarized it. It's simple. Now, the issue is, however, that what motivated Basel III was that this system of requiring banks to hold capital is supposed to stabilize the system. If they've got enough common equity, the bank won't go bankrupt, even if they lose some of their corporate loans. It would be a big disaster to drive them to insolvency. But the problem is that the system they set up has banks responding to a crisis by selling corporate loans or issuing new shares. The problem is both of those are hard to do in a crisis. In a crisis, and everything's falling apart, you go out saying, I want to issue new shares in my bank that just lost everything. The investors are going to say, you've got to be kidding. I'm not going to invest in you right now. So you can't raise new equity. Okay, what about selling loans? Well, the problem is in a big national or international crisis, every bank on the planet is trying to sell its loans at the same time. So it creates a collapse in the system. And this is what happened in the financial crisis. This story repeated a million times was banks were trying to raise capital and they were trying to sell assets they're trying to raise capital either by issuing shares or by selling assets. And everyone doing it at the same time created a crunch. And the whole system would have collapsed if it weren't for the central banks. The central banks of the world responded quickly by loans to companies, to banks and other companies. So the lender of last resort saved the whole system from collapsing. That's the story of the financial crisis. The remaining story is the Basel III people in Switzerland said, let's analyze how we got into this situation. How did it get so bad? And they thought, it's kind of a funny system because we're requiring banks to raise capital at the worst time. And that can't be the right system. And they looked around and tried to decide what to do better. Most countries in the world were following this kind of system. There was some people were impressed by the government of Spain having a better system, but the Spanish banking system collapsed anyway, so it didn't solve the problem. So Basel III came up with a solution, which was to allow the central regulators to add another buffer of 2.5%. If they think there's a bubble going on. They would do this before the crisis. And that raises the common equity requirement to 9.5%. So the idea is this is going to be a problem. Raising capital at a time of difficulty is always going to be a problem. And we can always rely again on our central banks, but maybe we can't. Maybe we shouldn't. And so the idea is let's take bank regulators and make it their obligation to raise capital requirements in advance when they see a bubble coming. Now, another thing that happened in the United States is the Dodd-Frank Act of 2010, because of intense public reaction to all the bailouts, said that the Federal Reserve can no longer use discretion in deciding who to bail out. They can operate a discount window, but it has to be completely fair and even for everyone. They can't decide we're going to bail out Bear Stearns and we're going to let Lehman Brothers fail. All they can do is operate a consistent discount window. So they've constrained, the Dodd-Frank Act constrained the central bank in the United States from exercising the kind of judgment that saved us from the crisis. And we're going to have to rely on some different things, like better capital standards, like Basel III, to fix the situation. Whether we're there or not is going to be a big question. This is a complicated system, and we put a lot of the best minds into trying to figure out how to prevent the kind of instability that we're seeing in this example, where everyone is short on capital at the same time, everyone is selling loans at the same time, and the whole system collapses. We've come up with different solutions, but they have to be implemented yet, and there are problems of implementation. The role of central banks and of regulatory authorities are evolving and changing, and it'll be a period of many years before we know where the system is actually going. All right, I will stop here. Next lecture is on investment banking.